रामू, 2 चाय दे यार।
अरे नहीं यार, एक चाय कॉफी।
इसको 30 डिग्रीज कर देते हैं।
अरे नहीं यार, 45 डिग्री सही है।
इस बार मनाली चलते हैं।
नहीं नहीं, गोवा।
सच है, we Indians disagree on everything, but we agree. SBI is the banker to every Indian.
अरे SBI कॉन्टेक्टलेस डेबिट कार्ड, सही भाई, आई एग्री।
SBI का वीडियो KYC सेविंग्स अकाउंट, सही है यार, फाइनली आई एग्री।
SBI से ट्रैक्टर लोन लिया, पाजी ये 100% सही किया।
SBI का होम लोन, जानू, दिस टाइम आई एग्री विद यू।
आप भी एग्री करेंगे। SBI is the banker to every Indian. बाकी बातों पर लगे रहो।
मुंबई मुंबई,
चेन्नई चेन्नई।
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Good morning, ladies and gentlemen, and welcome you all to the financial market E-Conclave, to save, to protect, and to invest in a volatile world. And we have very eminent speaker with us, Sri R. Gandhi, former Deputy Governor, Reserve Bank of India, to address us here as a chief guest. And now I would request our President, Mr. Debe Mukherjee, to kindly deliver the welcome address. Sir. Over to you.
Thank you very much, Arnob, and a very good morning to all of you, especially to Mr. Gandhi. We are really honored to have you with us, though virtually this morning. And welcome to all those who have joined online to the Bengal Chamber's Financial Market Conclave. I'm sure you would agree with me that to understand the dynamics and the functioning of the financial markets in these disruptive times, it's quite appropriate that the Chamber has come up with the theme and the focus for today's discussions, which is save, protect, and invest in a volatile world. I think you would all agree with me that traditionally the Indian financial market has been so structured and has evolved in a manner that's always looked at promoting savings and investments and optimizing resource utilization in a robust and efficient manner. But in the current disruptive times, the volatility that we see all around us has given a huge challenge, or has thrown up a huge challenge on all the aspects and all the areas of operations in the financial market space. When we talk of volatility in today's context, we are reminded of the VUCA environment, the business environment, which became quite a point of discussion post the 9/11 terrorist attack, when the volatility, along with the uncertainty, the complexity and ambiguity in business trends and functionings, brought huge challenges to the operations of business and to the operation of financial markets. But in light of the current pandemic, the situation possibly has taken a new dimension. And I was reading the other day that a new acronym has come up by an American anthropologist, Jemias Cascio, and he talks about something, the acronym is called BANI, which is B's that stands for a rather brittle and a fragile foundation that we see all around us. A, anxiety, and there's so much of anxiety all around, which has sort of triggered a non-linear progression or a disproportionate cause and effect progression that we see in markets. And that leads to I, which is totally incomprehensible in terms of the answers we get to our complex questions. Given this sort of a background, the uncertainty and the volatility, the different markets that we see, whether it's the money market where you have these mutual funds or short-term, low risk, low yield results, the money market, or the capital market. Now, capital market we find is doing amazingly well, but is it sustainable? The primary market, we see IPOs are doing well. In the secondary market, we see Sensex reaching heights. I think it's reached almost 60,000 last night. Then, of course, we have the banking system, and there possibly situation looks a little better in terms of handling of NPAs. And interestingly, two other markets where I would like Mr. Gandhi to sort of dilate a bit on. One is the pension market and the insurance market, because traditionally, insurance market, the pension market, whether how fully matured is it in India, how well it functions. Insurance market, whether there are some new trends that we see, because now insurance for the general public, it's more about risk mitigation rather than financial returns, especially in these times. Then, of course, we have the Forex market and the commodities market, which is very, very tightly regulated and controlled by RBI and the likes of SEBI. So all these markets, the dynamics of all these markets, now what we see would be very apparent trends, but the insights would only come out from experts. And on that note, I think we have none other and no one better qualified, I would say, than Mr. Gandhi to tell us a little bit more and give us some more insights on what has been assigned, I'm told, to him. The subject is what lies beneath and what lies ahead. So over to you, sir, Mr. Gandhi, and welcome you once again to our Financial Market Conclave. Over to you, sir.
Thank you. Thank you, Mr. Mukherjee. Good morning, everybody. Mr. Mukherjee, Mr. Tamal Bandapatiya, Arnab Chakravarti, and others who are listening to this webinar series. I'm very thankful to the Bengal Chamber of Commerce again to have invited me to share my thoughts on the subject for this day. It has always been a pleasure to be interacting with industry leaders and answering their queries. So let me start with sharing a presentation which I have. I would develop on the theme which just now Mr. Mukherjee mentioned about the Indian financial system, how it has evolved over the period and in recent times, what are the changes that are happening, underlying trends that we see, at least I see, and based on that, what's the kind of prognosis we can have for the system as a whole. Even though my experience have always been in the banking side, more from the central banking side, but since this conference is about the finance system as a whole, I'll definitely touch upon the developments in the other financial systems like the securities system or pension and the insurance and all. So just 1 second, let me try to share the presentation and we can carry it forward. Are you able to see my presentation?
Yes, sir.
Okay. Yeah, the Indian financial system, as I mentioned, and Mr. Mukherjee also mentioned, it has evolved over the period. Over the period, the Indian system has really been very well diversified in terms of various financial products and services. Of course, for long, it has been a banking dominated system, but especially post reforms of 1990s, we have today very vibrant financial system which expands beyond banking. We have non-banking services also, and in the securities area, we have debt market, equity market, and the mutual funds system have also developed. And beyond that, now in insurance, both in life and general insurance and in the pension funds. So over this period, we have actually modernized our various financial systems, institutions, and the infrastructure that we have created in the country very carefully. And we also applied our mind, policymakers applied their mind a lot about sequencing of the events, the sequencing of the reform that has been brought on, because certain things which, if it comes well before the day it is due, then it may not succeed. So the carefully planned expansion and diversification of the financial system has been the hallmark of our finance sector reforms. And today we are reaping the benefits of such a policy. Now, how is that? Yes, everything starts from the banking system. So by banking and the credit system, predominantly the banks, and we have varieties of banks on the floor today. We have commercial banks, that's what we call the universal banks. Then we have small finance banks, payments bank, regional rural banks, local area banks, like that, where different varieties of commercial banking institutions are there. And beyond commercial banking, also in the cooperative sector, both on the urban cooperatives and rural cooperatives, we have hundreds and thousands of institutions like agricultural cooperative societies, which are very, very widely prevalent in almost at the grassroots level of villages. And going beyond banking, we have the non-banking companies. There we have all India financial institutions and the asset reconstruction company, which are very unique to India. And beyond these things, we do have some legacy institutions like Nidhis and chit funds. They are still operating at the lower level, but they are also finding their own niche in the whole financial system in the banking and credit market. And as of now, the size of the banking system, if you look at the total deposits of as of last year, it was 151 lakh crores and advances of 109 lakh crores. And all credit institutions, where I have added up the assets of not just commercial banking, cooperative banking, NBFCs, and all India financial institutions together. If you look at the total balance sheet, it is the size is something like 260 lakh crores of rupees. That's the biggest size that we have reached in the credit side of the system. Then to have a little better understanding of the total credit system, how it has evolved over from the last 5 years, you can easily see that still the banking completely predominates of the just now I gave the figures of the total deposits and advances by the banking system. Next to banking, of course, is the NBFCs, and others are also having their own interests. But even though banking system has been predominating in absolute terms and over the years, there are certain changes that are taking place in the system. That's why if you look at the percentage contribution share of the different system, you will find that banking system's contribution to the credit has been kind of coming down. It was in 2016 when it was 73% share it had. Now it commands about 69% only. So earlier also we have been seeing, as the financial system evolves and more institutions come on the scene, varieties of institutions come on the scene, it is natural for the banking system to set the share of the total pie, and that's what is happening. It is good because that is what we call the diversification of the financial system. So, but banking still dominates, but its preeminence is slowly waning. NBFC share, NBFC and HFC, if you were to add up together, because both are the non-banking financial companies, which was about 15%. Or 14% in 2016, their share has now increased to 18-19%. So, and that also we have been seeing secular growth of non-banking institutions in our country. Then going beyond the credit system, if you look at the debt market, that is in the securities side, where bonds and debentures are being issued by the companies through the securities market, whether the stock exchanges through the list, whether it is by public offering or private placement, and the commercial papers for at the short end when there's people raise money through these debt instruments. That also, if you see, look at the size, the corporate bonds outstanding as of last year, last fiscal end, it was something like 36 lakh crores of rupees, and the CPs were about 3.64 lakh of rupees. And at one point in time, CPs were even outstanding CPs were 6 lakh crores of rupees, but post that ILFS problem, slowly the interest in CPs have trended down, and it is now at this level. So that's a debt market system. And if you look at the total funds flow to the commercial sector over the period, how it has been changing over the years, the data shows this way, that the banking system contributes something between 35 to 55% of the total flows over this period. It has been vacillating. It has between, and the other source of funds for the commercial system have come both from NBFC sector and the market, and the green bars, which a portion of the bars that indicates the foreign flow. The foreign flow, both in terms of FDI, that foreign direct investment route, and also external commercial borrowing routes. That has also been increasing sizably over this over these 15 years or so. The figures that I have shown, that you will find that the foreign sources contributed to something like 20% of the funds flow all through. And sometime it has, like last year, it has even gone up to 35-38% of the share. So that is a combination which is changing the color of the funds flow to the commercial sector. From the credit, there is a change. From the banking, there's a change. The other institutions are coming up, and the external funds are also flowing. This is a fund flow, the trends, because it has come to stay now. It is likely to be growing further. The banking preeminence is likely to be continuously be coming down. That is on the credit and the debt market side. When we go to the equity market, then again we have world-class institutions like the exchanges, both NSE and BSE, and we have depositories, we have other clearing and settlement agents, and very many variety of institutions which have today actually setting standards for the world. But even though we are not given due recognition of the improvement that we have done on the health for improving the health of the financial markets, especially the equity system, but many countries do borrow certain practices which we have been following for a long period. And in this, the size of the system, all of you are business people, so you'll be able to easily understand the figures that I have shown here. The resources mobilized in the last fiscal, of course, the figure is not very complete. It was for 3 quarters period only. The equity raising through the market had been something about 1.8 lakh crores, and the debt market, it has been quite very active. It is about 6 lakh crores of rupees, and the demat accounts continuously it is increasing, and this is the last year figure that, as I said, was of December. Post December, in the recent time, because of the impact of the COVID and other thing, lot of demat accounts have been opened. That because anecdotal evidence is there. So the interest of ordinary retail investors into the equity market, that is another thing which we have seen in recent times, and that trend is going to continue. The total demat shares, that is what indirectly something like our total capitalization in the market, that is about 250 lakh crores of rupees. Then the fund market, that is there we have varieties of funds in our system. That is a regular mutual funds. Then we have the portfolio management systems. Then we have VCs, venture capitalists, foreign venture capital, and alternative investment funds. So varieties of it is in these last 3, that is venture capital, foreign venture capital, and alternative investment fund. These are a recent phenomenon, and of course mutual fund industry has been there for donkey's years, and portfolio management system that is catching up with the rise in the high net worth individuals and even corporates, when they find when they are in their search for alternate investment which will give them better risk reward, they have been putting money through the PMS route, and that is today quite sizable compared to the mutual funds itself. So mutual funds net inflow last year, it has been at 2.76 lakh crores of rupees of net inflows, and this year it is likely to be much more, going by the numbers that we are seeing anecdotally during the current year. So and in the insurance, when we go to insurance, for long this has been the public sector proposition. Post reforms, when we opened up both the term insurance and life insurance sector, and today the total size of the life insurance, when I say total size, the proxy figure is the asset under their management of these life insurance companies. That is something like 39 lakh crores of rupees, and in the general insurance asset under management is about 3.5 lakh crores of rupees. And the premium continuously it is clocking up year after year. That means that the diversification of the financial assets of Indian citizens and the businesses have been expanding beyond banking, beyond equity, now into insurance, and even the pension sector. Then the next one, that also, if you look at the total contribution which had come as of last year, that was like 4 lakh crores of rupees. Very sizable contribution is coming to the pension funds, and their asset management, obviously it is very less because the NPS, these NPS figures only, that is hardly about 4 or 5 years of existence. So this is the total individual shares of different financial system. When we combine it together, how does it look like? This is what it is. In these past 5 years, actually, if you compare with the financial year of 2014-15, we would have by now doubled the size. So by today, the total system is something like 600 trillion rupees, that is 600 lakh crores of rupees, of which, of course, as I had earlier been mentioning, the banking side is still sizable, 261 lakh crores, the credit market. Then if we really look at how the shift has taken place between these 5-6 years, that you can see clearly from this pie chart, the banking system, which commanded 50% share of the total financial system assets in 2015-16, now it has come down to 43%. And the equity sector, which was having a share of 28%, today it is 33%. And the funds, mutual funds, which was about 6.8%, has grown to 9% share. Of course, pension funds, it has just reached 1% of the total share from almost nothing. So going forward, that is definitely going to be expanding quite a bit, and banking system is likely to be continuously be shedding share. This is the prognosis that we can have about the various markets in the within the financial system, how they have evolved over this period, and what's likely to happen in the coming years. There, the trends in the savings, it is my understanding that individual savers, there is a distinct behavioral shift happening, already happening. That is the first. They are ready to take risk because now that low interest rate regime has come because of the inflation targeting approach towards monetary policy. That would mean that inflation will be strictly be maintained between 2% to 6%, with a target towards December target towards 4%. That would mean that even if you add up 1% or 1.25% of real interest rate, the general interest rate in the fixed deposit side, and I think it will be hovering anything between 5.5% to 6% only, which the investor savers may not find it sufficient enough for them to continue to put their money on. So naturally, they will be looking around, and they have started looking around for better yields and better returns. That is where they have shifted their focus away from deposits into the alternative investments in mutual funds, equity, and other type of financial products and services. And added to that, the millennials, their behavior is very, very different. They also have, because they have the risk-taking capability much more than the traditional and older people. So they are straight away starting off, even going to the startup related investment. And today, with the talk of the town about cryptocurrencies, and I think they are very much willing to diversify much beyond the traditional instruments like bank deposits and intervention. So that is where the system is changing, and retail interest in the stock market has also increased. The way if you go by the number of demat accounts that has been continuously growing, especially during this period of COVID, it has really shot up like anything. So that and the SIP, systematic investment plans offered by mutual fund, the contribution continuously increasing. That is another indicator that the behavioral shift of savers is changing. The high net worth individuals, as I said, the PMS growth has been phenomenal. It is almost half of, even though number of people wise, it is not even 10% of the total mutual fund investors, but in terms of assets under their management, it is half. Almost half, two-thirds. So that is quite a sizable funds flow is going into that is high net individuals. They are also looking out for better rewards because they are ready to take better risk, higher risk. So that is happening. And institutions, it is not just individual savers. Even institutions are shifting their surplus funds, which earlier used to be in the current account of the banks or a little bit of fixed deposits. They have also been shifting their focus into alternate. They have found methods in money market funds where the fund flow has been quite consistently high and growing. So these savers are shifting away from traditional sources of funding, traditional source of savings area. Then if you look at the investors and the borrowers' behavior, there also things are changing. Large borrowers, they have very decisively shifted from credit to debt. They are now raising more and more funds from the debt market. That is NCDs and bonds. That is what they are going into. And their demand is also coming down because India has been changing more towards a service-oriented economy. As all of us know that 60% of our GDP is now coming from services. Services sector do not require large capital as compared to manufacturing sector. So that is why the demand for credit is also muted. There's another reason is that India has been becoming more and more of service economy. And the regulatory push is also there, that regulators, both the Reserve Bank and the Securities Market Regulator, SEBI, they're all pushing large borrowers to go into the market rather than depending upon banks. And the low interest rate regime, that is also helping the borrowers to go to the market and raise at very, very competitive rates, whether it is CPs or NCDs, and through private placements and other things. Of course, private placements predominate the debt market situation, and in the equity raising also, other than the public issues which have recent in the current year, we have got quite a bit number of IPOs and FPOs, but otherwise the fundraising in the equity market has been more through private placement like QAPs and preference share allotment, etc. These are the general trends I wanted to present you to reflect on. India, as I said, that Indian financial system has completely been diversified now. Variety of institutions and financial products are available for both the savers and the investors to lap on, and the borrowers. And there are certain behavioral changes, trends which are happening, which is good in the larger interest of the system as a whole. It may not be good from the particular institution like a bank or anything, but otherwise it has always been a good agree in the recent times, the markets, the systems, how they have changed. I will stop here. Let us have some discussion. Thank you very much.
Thank you, sir. Now, I would request Mr. Bandyopadhyay to kindly hit forward from here.
Thank you, Mr. Gandhi. I think there is not too many questions to ask because you have done so much of work I mean, it's little amazing, really amazing that you really worked so hard for this presentation. Lots of interesting things. So we have about 10-12 minutes. So I would not bother you because many of the questions I would have asked you already answered. So let me stick to only 3 questions. And you take your time to few minutes each to give this thing, You spoke about Mr. Mukherjee, Dev Mukherjee started talking about the changing face of Indian financial system, and then you graphically described that. Reserve Bank of India governor this week also, and one of his addresses said how the banking money from the banks flowing to the corporate sector is coming down, and it's been taken care of by other entities. So essentially the growing disintermediation. I think the big headwinds, we have a banks-led financial system till recently. But I think for the past 5 years or so, 2015 on, when the Reserve Bank of India, I'm coming again to Reserve Bank of India because you are a central banker. So when Reserve Bank of India did its AQR and then put 11 banks under PCR, prompt corrective action, so that credit growth, they could not have given credit, so on and so forth, multiple things. So now is a growing disintermediation of banks, and we are seeing different trends. The account aggregators, they are coming in, and NBFCs are actually advantage NBFC kind of thing. So two questions in this thing. The headwinds for the banking system. One is the market, and second is technology. I'll come to that technology part later. But can you explain to us in a few minutes, Mr. Gandhi, how the banking system? I mean, is it prepared to face, or you are seeing that is gradually the graph is very clear, it will go down, 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 and some of the banks will probably become irrelevant.
Right. Thanks, Tamalji, because the trends that are happening, that's what we should be aware of. From there only you are asking the question, and the disintermediation which is taking place in the economy. Of course, one of the key reasons for the disintermediation is technology. As you said, that we'll come to that later. But that's a very, very significant influence on the disintermediation effect that is happening across the system, and not just banking, the entire financial system also. Even beyond the financial system, also into the real sector, also technology is making very big inroads, and decisive changes are happening. Now, you mentioned about the AQR. That is a last straw. That's what I would say. That's from that time only, it has become very amply transparent and visible changes have happened in terms of banking preeminence coming down. Otherwise, underlying, we are talking about underlying trends that has been happening below the surface. People have not seen it. As I had shown you the 5 years figures only, but by earlier figures, if you go, I have been trying to get that, but across the system, I do not have much of information except the bank. That's why I could not present it. These 5 years, I could get other alternate information. But if a real researcher, if they would go, they'll be able to identify that banking system, that is a credit system, has been consistently been churning, and the big ticket credit, that is not happening nowadays. That is what is the reality. There are several reasons several reasons contribute to that position. Number one, the bad impact on the banking system, because they scotch their fingers by funding the infrastructure mega projects of 2010s. That has clearly stopped, and it is unlikely to be again be that big projects to get funding from the banking sector. It is going to be not there. It will be a very muted support for the project financing will be coming from the banks. So the project fund project institution, they'll be looking more and more beyond the banking system, that is into the debt market to raise the funds and equity market. And another thing which has happened is that government, post 2015, big infrastructure project, it is now being funded by the government. So in this, I do recognize that in my presentation, I am not in the debt market system, which I should have ideally included government debt also. So that would have given a real, a little more extra picture about the Indian financial system, because they are also a very big borrower, and they are funding the investment. So that part is definitely will be there and has been there in these years. That's the second reason why the banking system disintermediation has come down. Third, the developments in the alternate market, whether it is a debt market or equity market, and the foreign fund flows. All the three have also increased. There is a big demand and appetite, risk-taking by the savers and investors for these alternate arrangements. There is a big foreign interest. The FDI figures, as we have seen in the last 3-4 years, have been really very strong. That is also another source of, as I showed in one of the pictures, that not less than 20% of the fund requirement today is coming from the foreign sources. So that's a extra interest which is coming from elsewhere. So when we add up all these things, the final result is banking as an institution, their share will be continuously varying. I'm emphasizing the share. Share coming down does not mean that in absolute numbers they will be losing. Because the Indian economy is expanding, continue to be growing. So in the larger pie, they may get a lower share, but they'll be able to clock their own growth. Because banks have now shifted more towards a personal finance and retail finance, where very big scope is available. As the economy grows, more and more of middle income group entity persons will be increasing. It is the personal finance segment which they are today rightfully identified the place to be in. So these developments, so banking will not go away. Banking will still be growing, but their share in the system will be coming down.
But Mr. Gandhi, just one line answer in the current context, all the technology and plus the liquidity sugar rush. Do you say it's advantage NBFC?
Advantage NBFC, yes, at the margin, yes. Okay. At the margin. Okay. Because their size is still, compared to the banks, it is much lesser. So by a net advantage, they definitely have got because of the excess liquidity that has been created in the system. They all come out of the ILFS kind of crisis situation in these 2 years. They have really come off very well. And going forward, because of the technology and the NBFCs have the nimble footedness in terms of tying up with fintech companies for offering better services as compared to banks. So right, that is going to be a big challenge for the banks to face on.
Okay, so I'm coming to that only. You spoke about, yes, banks, the corporations, larger ones are going to the debt market. So banks have the opportunity to grow the personal finance market, the retail one. But then it comes to the second headwind, the technology. You know, what we are seeing now, I think the different entities in the marketplace, they can tie up with banks and the money can flow to the buyers. Like for instance, Zomato or Swiggy. If I am buying 1.5 kilo of biryani for 1,200 rupees, I can have it paid in EMIs, or I am buying in Amazon, so on and so forth. So which primarily the banks were giving me and you the home loan and auto loans. Some of the NBFCs are giving me and you the money to buy fridge and refrigerator and AC and TV, etc. But now the market has gone to that level of giving money to buy biryani, okay, for 5,000 rupees and 2,000 rupees kind of thing. And more importantly, it's also not only on the asset sides, it's also happening on the liability sides. Some of the banks have started raising deposits over these platforms. So I am asking you, Mr. Gandhi, are you worried about this? Because when I am taking money from you to buy biryani, it's okay. The risk is yours, whether I pay or not. But when I'm keeping money with you and as a depositor, of course you are representing a bank, but I don't care about the bank. I see on this platform I'm keeping the deposits and all. So do you think it can lead to a sort of systemic crisis at some point of time?
Yeah, I see the point about you mentioned, especially in China when the fintech companies expanded their presence in the liability side. That created quite a bit of concentration and the problems. That is where India has taken a very, very strong position, long-held position by the Reserve Bank, that money, that is deposits. If somebody can be accepting deposit, it has to be only banks. Post 1996 CRB crisis, the Reserve Bank stopped NBFCs. It has not authorized any new NBFCs to accept deposits. So deposits today can be in the banks only. Collection can be done by anybody. Deposit collection, that's what has happened today. The fintech companies which are offering the platform for mobilizing the deposit for the banks, either directly as their agent or indirectly when they offer, as you said, that through small ticket funds which can be collected by the fintech because of the technology enables them to do that. But funds cannot be in their hands. Funds have to come to the banks only, deposited to the banks or in an escrow account. All the payment PPI and wallets and that type of entities, India has put a very strict condition that the monies collected will have to be in escrow accounts, which is maintained at the banks, and banks become the escrow agents who will be able to oversee that the debits into that from those accounts are done only for the approved purposes. That's the ring fencing we have done. Technology helps small ticket deposits to be increasing, but the funds collected by them, retained by them. But first of all, if in the asset deposit, it cannot remain with them. It should be transferred to the banks only. But as a part of the floating balance, what we call the PPI and balances, that amount, the collectors, the fintech companies, or the payment system operators, they cannot keep the money for themselves. It has to be kept in the third-party escrow account mechanism. That's a careful thought. Reserve Bank has done it. That is going to help us in ring fencing the risk which our eyes will be emanating, as you mentioned.
Thank you, sir. We have almost completed. Yes, we have. But Arnab, with your permission, I'm taking 1 more minute, sir, the last question, so that you can compress your tea to 3 minutes instead of 5 minutes. Mr. Gandhi, you said what is happening in the financial system, jo vatavaran hai, oh, this is good for everybody. I have just one question for you. Not a question, it's an advice from an ex-central banker to the community of savers. Now, what's happening globally? This liquidity sugar rush and the central banks across the globe, flooding the system with money. Of course, for reasons all of us know, I will cut it short. But what is the net result of this? On the one hand, my neighbor is just sitting at home and trading in the equity market and making tons of money every day. And I am a senior citizen. I kept all my life savings in the bank, and I run my family with the earning whatever I done, and which I was getting 8% or 7% 2 years back. I am getting 5%. On my savings bank, I was earning 4%. Now I am earning 2.75%. So this asymmetry. Now, how what would be your advice to the second section of the people? We don't have any social safety net here, and there's a vast. I don't want to get the numbers and all. There are vast section of the population are living on their savings, keeping in bank deposits.
Okay, that's true. That is true, especially for those at the wrong side of their age who are always dependent on fixed, a very safe fixed income in terms of bank deposit interest. That segment has been very much affected. That is a thing to happen when we brought in low interest rate regime. I recall that when 2014 or 15, I made a speech to the Depositors Association. That time itself, I did mention that this is what is going to happen because of the when we have low inflation target, and when we achieve that, the income from the fixed deposits kind of investment will be very less. So savers will have to slowly opt for taking higher risk. That is one. That second, the point that you made about since we do not have a social safety net in the country where this particular segment can go, that is where the fiscal has to support it, and in a way it is doing. If you look at today, the interest rate that is being offered by the post office savings system, and also the floating rate interest given by the government of India bonds, they give much better returns than the corresponding deposits of the banking system. So in some way, it is not a complete alternative, but something is available from the fiscal side to support the senior citizens type who would not be wanting higher risk to be taken. So that is one option. Third, a suggestion, it is not a suggestion, that's what has happened elsewhere. When everybody realizes that low interest rate regime has come to stay, then we will find that it is easier to live on debt than you will have a forced savings rather than you'll enjoy more goods and services now and pay for them later. That's a trend which will happen, that will continue to happen. And once we have stability in our financial system and the economy as a whole, that will be a good thing to go in for. Anyway, that's a little, another 5 years, 10 years, it may take that kind of behavior to happen, but that will happen.
Okay, Gandhi sir, the last question before you go, because we don't get, at least Bengal, not at personal level, Bengal Chamber doesn't get a deputy governor very often at their conferences. So since you're here, let me ask you the last question from micro to macro, from advice to expectation. Now, on the, this, everybody has started US FOMC, what happened at the FOMC meeting this week. Now, Reserve Bank of India Monetary Policy Committee will be meeting next week. Next week, in the first week of October. Do you think that is and what we see is this touch wood, probably the third wave? We are, if at all it happens, we are better prepared to tackle it, and the destruction by the second wave now it's behind us, hopefully. of COVID pandemic I'm talking about. Demand is picking up, consumer demand is picking up, things are going up, stock market is going up, so on and so forth. Now, is it the time to start normalization? Because the ultra loose monetary policy that Reserve Bank of India has been following, and rightly so. But always we see this in retrospect that it should have been earlier. Like you were there, Dr. Subbarao's time. He was pretty liberal in flooding the market with liquidity, but probably a little slow when the time was to start tightening, and that's what people say that you were taking baby steps. And by the time he started taking larger steps or giant steps, it was pretty late. So, do you think it's the time for Mr. Shaktikanta Das, Reserve Bank of India Governor, because there are many industrialists of the chamber now, they'll be listening to it and they have a stake there. So why don't you tell us that? Okay. And if not now, then is it in December? Is it in January? When should we start, sir? Okay, welcome.
Thank you. In my assessment, the normalization of monetary policy, ultra loose monetary policy in India is several quarters away. Definitely not in this fiscal. That's my assessment. And please remember, in a recent address by Deputy Governor Dr. Patra, he also mentioned very clearly that we don't like tantrums, we like tepid and transparent transitions, right paths rather than crash landing, and with a due advance notice. That monetary policy committee is very, very firm on that. Sufficient indications will be available to the market whether they are going to change their accommodative stance or tightening when it is going to happen. The pre-warning will certainly be available. Number 2. 3, we are not yet pre-COVID level absolute growth, right? Still, we are, even though we are growing very fast, we have not yet reached the absolute level of growth of 2019-20. That is the first thing we have to cross before thinking about anything tightening, overheating, and all those arguments can come only much beyond. After reaching that also, we have to be growing much faster. Then only the economy might be overheated, inflation could rear up. That kind of situation is definitely not so soon. So that we have to be carefully watching. Good indicator will be credit pickup. So credit in this half year so far, actually there has been credit growth has been negative in this fiscal. So it has to gain a lot before becoming a cause for concern. And inflation, as maintained by Reserve Bank and the MPC, that is definitely transient. They could we are now seeing that inflation is coming down near about 5.3%. It has already come. It can go down. It is what is a projection so far. So that's why if you look at all these factors, growth has not yet come back to pre-COVID level absolute position. To get the economy overheated, to worry about normalization and other thing, that is going to happen much later. That is my assessment as of today.
Thank you, Mr. Gandhi. So what we have got, apart from his very incisive and data-driven presentation, what we have got from former Deputy Governor Mr. Gandhi is its advantage NBFC at this point of time vis-a-vis banks because of the cost of funds and the fixed cost advantage, etc. B, this new reality is this: the saving community has to accept with this low interest rate regime, and they need to reorganize the way they want to do this. And he says that there are from the government and Reserve Bank of India and post office, etc., there are bonds and deposits which offer relatively higher rates, so they have to settle for that. And finally, Mr. Gandhi thinks that the time has not yet started for Reserve Bank of India to unwind. Yes, inflation is relatively high, but this is not because of supply side issues. This is not because of demand, but of the supply bottlenecks, and normalcy has not yet returned to Indian economy. So he does not think that Reserve Bank of India will be in a hurry to unwind and start normalization. With this, thank you, Mr. Gandhi, and thank you, Mr. Mukherjee. That brings us to the end of the session. Stay safe. Over to you, Anna.
So, sir, with this, we are really come to end of this opening session part A, and we are really thankful to Sri R. Gandhi. With this, we will take a short break, and then we will join with Mr. Chandrasekhar Ghosh, MD and CEO of Bandhan Bank, in a couple of minutes on the opening session part B with the title Strategies to Harbor the Desired Growth During Next Normal. With this, we will end this part A session. Please stay with us. Thank you.
Thank you. Thank you.
Thank you,
Thank
sir.
you.
Thank you, sir. Thank you.
रामू, 2 चाय दे यार।
अरे नहीं यार, 1 चाय कॉफी।
इसको 30 डिग्रीज कर देते हैं।
अरे नहीं यार, 45 डिग्री सही है।
इस बार मनाली चलते हैं।
नहीं नहीं, गोवा।
सच है, we Indians disagree on everything, but we agree. SBI is the banker to every Indian.
अरे SBI कॉन्टेक्टलेस डेबिट कार्ड, सही भाई। आई एग्री।
SBI का वीडियो KYC सेविंग्स अकाउंट। सही है यार, फाइनली आई एग्री।
SBI से ट्रैक्टर लोन लिया, पाजी ये 100% सही किया।
SBI का होम लोन। जानू, दिस टाइम आई एग्री विद यू।
आप भी अग्री करेंगे। SBI is the banker to every Indian. बाकी बातों पर लगे रहो।
मुंबई मुंबई,
चेन्नई चेन्नई।
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
we'll just, hey, Arnab,
Yes, sir.
Arnab,
We are just
give us 1 minute. Okay. I will just have a little chat among us. Gozda, there's no tough question. It's basically in your area. We'll have a discussion about story.
Welcome back to the opening session part B of Financial Market E-Conclave. We have Mr. C.S. Coach, MD and CEO, Bandhan Bank Limited with us, and Mr. Kamal Bandyopadhyay, author and columnist and mentor of our Bank and Finance Committee. Over to Mr. Bandyopadhyay.
Welcome, very warm welcome the audience to the second session with none other than Mr. Chandrasekhar Ghosh. And it is Arnab's discretion, so you have to suffer me consecutively for 2 discussions. Strategies to harbour the desired growth during next normal. That's the subject. We'll have about 20 minutes till 12:20. If there's any question, please do send the questions. Mr. Ghosh will answer that. I would like to believe that when you are talking about next normal is the normal beyond COVID pandemic. That's what. And nobody is better qualified than Mr. Chandrasekhar Ghosh to talk about that, because he has the pulse of rural India, semi-urban India. By the very nature of business which Bandhan Bank does, he is the founder and MD and CEO in vast part of the hinterland. This bank has been operating. So you are, Mr. Ghosh, you are seeing people from very close quarter, and you are one of those CEOs who you don't believe in sitting in the ivory tower. You go and meet people in villages, in small towns and all. So first you tell us what is this next normal, because all of us are presuming that the worst is behind us. The second wave is receding. We are better prepared for third wave. So even if a third wave comes, that should probably we will be able to tackle it well. And economy has started looking up. Consumer demand is picking up at every level. And let's not talk about stock market, because we really don't know what is driving the market. I guess nobody knows except for liquidity and all. But let's not talk about macro. What you are good at is telling us the micro stories. So tell us, what are you seeing, how things are changing?
Okay. Thank you, Kamalda. Thank you, BCCI, to given these opportunities to share my thing. This pandemic is a very different at the time we are passing. And the last 1.5 years, the people have been learned much more. And they are now decided it is a part of the life, and will be like to continue our life, business, everything with this, the COVID situation. This is in first primarily learning has come from the large number of people. And I go to this, the rural is more in the interior. Second wave have been affected in rural. After that also today we saw that the people are very much strong in their mindset on that. They will be like to running their business with this situation. No mask. People are feeling it is a normal on that. This is a one side in the people perspective.
Mr. Ghosh, just to, they are not wearing masks?
No, I have been visited on that at the North Bengal total, and only I saw in that my driver the mask have been used in the Siliguri city, because that is a 1,000 rupees the fine. If you are in the card, that time also you must be aware about the mask. And after that, no one using, not a single person I have not finding out and that they are using the mask.
Oh, I don't think that's a very good story. I'm sure, sir, you are well connected. You are passing on the message to the respective administrations.
No,
right?
we have given on that, but the people, large number of public feel that now it is a normal.
Okay.
And Corona is over. So we'll be like to do the business. Otherwise, my life will be like to disturb on that. Okay. So they are feeling that along with these things, will be like to run the business. Coming to the business point of view, whatever our respective areas, there is two types of business which I find out on that. The people are involved in that, the essential goods selling, the grocery shop and vegetable, fish, egg, chicken, mutton, this type of. Another kind of business people are doing, which is the small manufacturer, which depend on supply chain, local supply chain, if I say that specifically. But it is seen that the local supply chain is more disturbed compared to the essential goods sellers. So that essential goods sellers, and another part we find out on that agriculture and allied. So they are also partly depend on local supply chain. If I say that some of my customers are having the 2 cows, and she is getting the milk, and milk are purchased by the Calcutta people, buy from them, or they will be like to send some of the middleman purchase from them and given to Calcutta. Because of the local supply chain is not working, they are not able to sell it. But agriculture, they are getting some of that because of the government are buying. So this is the supply chain is because of disturb. So there is some effect has come to those businesses. Now gradually, if I say that the manufacturing supply chain, now it has been open because all our big heart are open. Customer says that the surrounding states people are now, movement have been started. There is no RT-PCR test is needed. Earlier it was needed. So that the movement has come very good and very quick. It has come picked up the business. And third advantage, this is just before the puja. Before the puja, always a business is picked up. And the people business are doing much more in a before puja, which even that they are 60% of their income has come to this time. So I saw that the movement of the customer, movement of this, the consumer and also producer are matching together in the big heart. That is have been showing that the sale have been increased and they are coming to very near to the normal.
Okay. Oh, Mr. Ghosh, tell us, you have substantial presence, huge presence in West Bengal, in Bihar, and I am not very sure your presence in UP, but you are present there. Now, these are the 3 states where the migration, most of the laborers and all who come to places like Mumbai and Bangalore and all, they are coming from these other states. NABARD has done a recent study showing what exactly happened, migration, then reverse migration, why they have gone back, and why they are again planning to come back, or some of them have already come back. Like in Mumbai, where I stay, I am finding that there was a time when all this, the security guards in the housing societies, they're all leaving, and now they're all coming back. They have already come back and all. So in this migration, reverse migration scene, what do you see when you go and to these areas like UP, Bihar, and West Bengal? What are you seeing? Those guys, those people who had left after the first COVID wave, are they staying back? Are there business opportunities or agriculture which can take care of their livelihood, or they are getting disappointed and returning back?
The true learning has come from this, the migration of the people. One learning is that they are immediately returned back. Even those are traveling to Bombay and other cities by flight, and they see that the 60% of the passenger are the wage earner are returning back to work. So this is the one side. Ground level, we are seeing that very different. Another thing on that. Normally, we are lending to the women, and women entrepreneurship developed in a huge in the ground level because of this, the microcredit support on that. Now they are seeing that after this, the learning from the corona situation, they say that we cannot be like to depend on single business, single income. They are searching as a entrepreneurship mode. Why not? I can be start another alternative business, which can be support me this type of crisis time. I will not face a problem. So in this is, if you see that, there is a lots of people, no, they are using the Toto or rickshaw for the passengers. So because of the local train are stopped, so people are not using the rickshaw and Toto to coming from the home to rail station. They are not getting the job, their income. They are used this rickshaw and also that the van and Toto to selling the fish and the vegetable in a door to door, which is they say that when the season is be dull, I'll be use it for the purpose. When the season is a very tough, very good, I'll be used for that purpose. So this is in one kind of I find out. And second thing find out on that, lots of manufacturing unit, they are now starting the new enterprise, which is a local level, very good demand on that. So alternative business model, they are prepared in this time, and husband, wife, sometimes I am finding out on that, they are jointly working together. They not only the women are enterprise, they are now jointly working and sometimes scale, sometimes they are alternative business running on that. Earlier, if you see that, give another example. There is a small grocery shop in the house. So because of the corona situation, people are dependent on the local level store. And now husband is using to coming to this, the wholesale market to buy. Earlier, these women buy from the local market, sell to their store. Now their husband is going to this, the wholesale market and cheaper price and return back, and jointly it is selling. So that is also, we are seeing that the sum of these wage earners are not returning back. They are joint with their wife and running their business, scaling their business, and alternative business they are searching and developing on that.
So it's wonderful to hear that, Mr. Ghosh. It's basically the spirit of entrepreneurship. So on the one hand, in urban India, among the educated youth, we are seeing the startup culture. You know, that's booming and valuation is going up, etc., etc. But you are saying these startups are also happening even in rural India in a different way, right? You are saying that it's no more the domain of women only to do this kind of business. The husbands also joining, and they're always finding out new opportunities and all. But if I ask you, have you done any study, or what is your from your first-hand experience, if 100 people have gone back from Mumbai and Bangalore and Delhi to West Bengal, Odisha, and West Bengal, Bihar, and UP, how many of them have come back, and how many of them are staying back in search of livelihood or building new businesses?
No, what I say that there is no study, but what interaction with the people.
Yeah, anecdotally, what do you see?
20-25% are retained, and 75%, 70-75% are returned back for that.
Okay. So there was one critical question I want to ask you. I am not doubting. I don't have any doubt about what you are saying. But where is the money coming from? Because if somebody wants to do and get into new business, because the popular perception is this, the impact of COVID has been so severe that people at that level, yes, one thing is this, their business model is very different, is high margin business, cash flow is faster and all, but many of them actually have ended up eating their capital, because the tailors and the other shopkeepers who are keeping their workers, they have kept their workers, they have given them money as much as they could for how many months or many months, their salary and wages and all. In the process, they actually need capital more than the debt, because those people have already finished off whatever their savings and all. It's really bad situation. So how are they meeting their financial needs to get into these new businesses?
Tamalda, this is different views from my side.
Please, welcome.
I find out on that when I meet the customer, actually, these low income level people or bottom of the pyramid people very cautious to spend the money in the time of crisis. They know that. And the second point on that, they are in this time haven't got a free ration, which is food. They have not any food cost now. So that they are not spending the money. In that sense, they are utilize their money to their purpose of the productive. So this is in one side. Though we are saying that the consumer is not yet started, but if I say about the urban also, going to any mall, huge queue, and you are not finding out any store which is any space you can be entered on that. I am also surprised on that people talking in the one side, and we are seeing the reality is a different side. And that is the way we are finding out on that. The people have that very conservatively expenses their money in the time of Corona. And now they are starting to business again, and the business is coming the good revenue from that. For that the reason it is coming on this.
So you are saying this is not this perception which I have is not correct. It's not that people have exhausted their savings and their money. They are actually pretty conservative in spending during the Corona time, and then various government schemes etc. also help them, and now they are getting to new businesses, right? That's what it is. So Mr. Ghosh, the time now as we speak, we are about a little less than a fortnight away from Durga Puja, I guess, right?
Correct.
Yeah, it's about a fortnight away from Durga Puja, which is the biggest festival in Eastern India, and which is, you yourself said that a large part of the business is only generated from there. So you leave that aside. But otherwise, when do you see the normalcy returning, or the pre-COVID level businesses are in terms of their earnings coming back?
No, if I go to the historical perception, if you see the 2019-20 was a Corona started in April and May in the lockdown.
Yes.
And March has come very normal. All things in that. And again, May have been come to the very bad impact of the second wave. So that is my point on that. Again, the March will become to the very best way to come into the pre-COVID situation. And 20 to 23 will become as a normal, as a pre-COVID situation. Whatever the normal financial year, I hope that will be run on that. Subject third wave will not come. People believed it, whatever the vaccination happened. No, 45% vaccination happened in a single dose, and 15% is in double dose. That have been given the confidence of the people, and also it has been seen that the number of affected people have been come down, and so that the very hope on that this financial year it will become as a normal scenario.
Okay. So we don't know about the third wave, but as things stand today, you, Mr. Ghosh, you feel that by March 2022, that will be the end of this phase, and the new year, new fiscal year, which is March, FY23 will be the new normal year. I mean, post-COVID. I have a few questions. At least one we'll ask you, but before that, I have one question for you. Is this, since the subject is strategies to harbor desired growth during the new normal? So tell us the strategies from the lender's perspective, strategies from the borrower's perspective, and strategies from the government perspective. Just give one sentence each or whatever you want. 2 minutes you can talk. What should be the strategies from the different constituencies, the lenders, the businessmen and women, stroke borrowers, and the government to harbor growth in the new normal scenario?
No, Tamalda, if you see that in the last 1.5 years, or we can say that nearly 2 years, the business is a disturbed, no doubt. It is in feared or movement has been not happened. If I say that till now, it is not surrounding states, people are not coming to Calcutta for their health treatment. So lots of business will be lost. Travel will not get the business, and local transport will not get the business, and local shop cannot get the business. Lot of things will be like to further improvement will become on that. So that should be like to focus by the government, how gradually it can be like to open, and then people movement will be start. If people movement will start, automatically the small business or big business people will be get the business more. And second point on that, because of this, the pandemic is a very extraordinary time. This is once in a time in the life, all of us. And there is an extraordinary some measurement already taken by government. And it should be like to further extend on that. If you say that the government has given the moratorium, government has given restructuring, TLTRO, credit guarantee scheme, lots of initiative government has taken. So credit guarantee scheme on this type of facilities, it can be like to further some of the depend on that, the demand. Some of the industry, it will be continue on that. This is a government side.
You actually meant the RBI side, right?
RBI side.
Yeah. And finally, the lender side.
Lender side on that, will be like to lending to this business, because lots of fear working in the lender's mind. We can come forward on that, which are the best way we can be like to support to the entrepreneurs. And if entrepreneurs will come back, so lenders will be like to very good on that. But if you see that this is in Corona, this is a too big learning. For business point of view, big learning is there. The India is a big country. Huge number of people are living in the rural and semi-urban. Till now, they are not accessing the credit. So we should be like to provide the credit to them, and they also like to build up their enterprise or new business model for this learning of the Corona. So that can be helpful in these people will be like to come as a self-reliant. Until the people will be not self-reliant, every time any crisis they are depend on government, and government cannot be supported that much. So that will be very big challenge for the country future.
Thank you, Mr. Ghosh. Yeah, it's a very, very good message for the entrepreneurs. Now, I want you, before we say goodbye to you, I know you are busy in a board meeting. You need to go back. I have just one message I want from the savers. There are many questions. I'm just picking up only one question. Senior citizens, where do they keep their money? Because the banks are cutting their deposit rates every day. How do we ensure our future income flow, keeping money with banks? What would be a two-sentence advice to the senior citizens?
No, it is not only depend on deposit for earning the money for future running the life. That should be like to diversify some of the other business also. And I hope that this is a temporary phenomena now. Whatever the liquidity is a very huge in the banking hand, so that the rate is coming down. The future, when the advance, the demand will be increased more, which is now we are seeing that the advance is coming more. and that will be automatically rate will be increased, and they will be get benefit. So they will be also adjust with this the some liquidity of the banking industry, which is the rate will be come down, come up. They can be adjust on that. It cannot be like to good way on that. The only this rate will become in the future. That is not the good thing for them.
Thank you, Mr. Ghosh. It's very useful, tips. And as I said, from you, we always get not macro discussion, but actually from the field what you see, and what you see is very encouraging. You are seeing the entrepreneurship spirit. I will not call it revival. It's a reinvention again. I mean, the way people are, unleashing.
One point, Tamalda, see that the credit demand is fantastically coming.
Okay.
We saw that, and collection is coming very good on that compared to the last 3 months. So that can we see the hope on that future. Very good.
Thank you, Mr. Ghosh. It's a very different perspective from the banker. Just now we are talking about credit growth is negative. And here is one gentleman, Mr. Chandrasekhar Ghosh, who caters to the bottom of the pyramid, says there is a phenomenal credit demand. I don't want to waste our time to summarize for the sake of for the sake of being punctual. We ending here. Only one piece of suggestion, Mr. Ghosh, is this. You please wear your mask, even though your borrowers are not wearing. And from a bank, I think you should, because you have done a lot of things about what do you call it, on financial inclusion, basically teaching them how to approach savings and how to get credit. I think it's a time for a bank like yours, who are linked to the hinterland, also to teach them that even though COVID threat is receding, even though the worst behind us, it is not the time to let our guards down. We should continue to wear the mask. Okay.
We are always using. Thank you, your suggestion.
Please start counseling all your borrowers. Okay. With this note, thank you, Mr. Ghosh, and thank you, Arnab.
Thank you, sir. Thank you.
Stay safe. Namaskar.
Thank you. I would request Mr. Bansal to kindly deliver the vote of thanks, please.
Thank you, Kamalda. Thank you, Arnab. Kamalda, I'm not wearing my mask, but I'm alone in my room, so you can exempt me from that comment.
All of us. Yeah.
A very good afternoon to all of you, ladies and gentlemen. As we conclude the first part of the financial market e-conclave, I feel immensely privileged to have this opportunity to propose a formal vote of thanks to our distinguished speakers and stakeholders of this prestigious forum. It has been an honor for us to have the august presence of our chief guest, Shri R. Gandhi, former Deputy Governor, Reserve Bank of India, and our chief mentor, Mr. C.S. Ghosh, Managing Director and CEO of Bandhan Bank, and also the former President of Bengal Chamber of Commerce and Industry, who have kindly joined us despite the busy schedule. I must also express my sincere thanks to all the speakers of the upcoming sessions for joining us in this prestigious e-conclave. It would have not been possible for us to bring this event to you had it not been for the unstinted support of our sponsors, and I thank all of them for their participation. We would like to express our sincere thanks to our well-wishers and delegates, members of the media, and our speakers. Therefore, as we conclude our opening session, I would like to thank you all for partnering with us in this prestigious e-conclave. Hopefully, we'll not have an e-conclave next time. We'll have a proper physical conclave like earlier times. So our next session will be on expanding limits of financial markets, the power of technology. And we have many eminent speakers. We will now take a very quick break. Stay tuned with us, and we'll be back in a few minutes. Thank you.
Thank you. Thank you all. Just let us check quickly our voice and the video. Welcome back. We to the Financial Market E-Conclave. We have a very interesting session coming ahead with us. It's an experts roundtable on expanding limits of financial market, power of technology. It will be moderated by Mr. Mayank Jha, MD and partner of Boston Consulting Group. We have with us Mr. Srikant Nadella, CEO of KFin Technologies Private Limited, Mr. Pankaj Bansal, Chief Business Officer, Bank Bazaar, Mr. Bikram Singh, Head Consumer Business, Experian India. We would now request Mr. Jha to take it forward from here. Thank you.
Thank you, Arnab, and good afternoon to everyone who's watching this, and a very warm welcome to the esteemed panel that we have. It's our packed 30 minutes discussion on the topic of how technology is intervening in the financial market space and how it can be reimagined to expand the limit in which it affects the financial market transaction. Now, it is beyond doubt that technology is more deeply ingrained in our lives, more than ever before. Today, whether we order food, book our travel tickets, interact with family and friends, technology is a key enabler to make those interactions happen in a more convenient, in a more cost-effective manner. While financial services has been not at the forefront of it, but a lot of leaps and bounds in which financial services have moved ahead in terms of adoption of technology. And I think there are three trends because of which this has happened. The first is the cost of technology by itself is going down at a very rapid pace. Processing power is doubling every 2 years. Cost of data storage is coming down 25 to 40% on a year-on-year basis. So making technology work for us is getting more and more affordable. The second trend is the public infrastructure that has been created in India on the technology side is enabling the entire banking and financial services infrastructure to act. Today, we have more than 50 million smartphone users, which is making the reach to the end customer possible more and more. Today, we have 1.2 billion Aadhaars in the country, which help us manage identity, which is an important aspect in financial market. We have a world-class unified payments infrastructure, the UPI, which has crossed 2 billion transactions this year, and it is actually bigger than what American Express does globally. The third trend is India is getting data rich as people interact. They leave a data footprint. We are storing more and more absorbable data, which can be used to take financial decisions. And these major trends are impacting us. These trends help improve both the reach to the customer, the access to financial services, and doing that in a more convenient manner. Now, as we move, I think as our customers interact with more advanced consumer companies, their expectations of financial services companies are also determined by the same experience. Why should a bank account opening not be as seamless as a Netflix account opening? Why should mutual funds take 3 days to get our money out? So the real question is, have we explored the full potential and what is the road ahead in front of us? So with this, I would like to spark off the discussion with our panel members. Maybe let me start with Srikant. Srikant, you have been at the forefront of technology, helping a lot of financial market players leverage your services to be able to drive their processes more effectively. And you've seen this a lot across markets. Where do you think we as India are compared to developed markets in terms of the technology infrastructure and the use of technology in financial services?
Thank you, Mayank, and a very good afternoon to one and all. Thanks a lot. It's indeed an honor and privilege to be here. Very important topic, and probably important to a point of being cliched, I guess, the role of technology in growth. I think it's there used to be a point in time when long back when I used to be asked in terms of, does your company have digital as a department? And I guess today you look at the world, and then basically every company, every entity is just digital. I mean, there is no other way. It is sustainable and could be delivered to the expectations and outcomes that are required. See, the technology, we work in the space of asset management largely. We are the country's largest registrar, one amongst top 5 in the world. We kind of fuel the mutual funds, the alternates, the hedge funds, the pensions, the private retirement schemes, insurance to a certain extent, the equities in the form of the registry work. Technology, as I have seen evolve, has had a significant and a profound play in multiple areas. First and foremost, the customer being the front and center of it. And I'd be more precise and pointed to your question, Mayank, in terms of how are we placed vis-a-vis the rest of the world. I'd like to believe that if we were to draw a continuum, we are probably on certain aspects ahead of the rest of the world. There are aspects where, we are probably catching up, and there are aspects, where we are behind and significantly behind as well. Now, what are the areas where we are ahead of where? I think adoption of something that has already been conceptualized. There is always a first mover advantage, and there is always a significant second mover advantage. And I think that is what we seem to be adopting, which is effectively pick the best the world has to offer, scale it up rather quickly, and deliver significant outcome to that. It has its value, it has its advantage, which is effectively that, something like what you just mentioned about UPI, processing more transactions than American Express, is a classic example of adoption and then driving at scale. It lacks, obviously, the point of being the early mover and the innovator in that space. But that is not to say that, we haven't and are not making amends in that area to catch up. And there are definitely a number of areas, I'd like to believe we're doing it. The areas that we are very fast catching up are consumer-facing, platforms. I think the rise of the investing platforms such as, Zerodha and Paytm Monies and ET Monies and who have you, itself is an indication in terms of how fast we could adopt. But I'd like to believe that in times to come, you will see world-class and probably cutting-edge, features and functionalities rolling out of India being adopted by the Western world as well. The areas where I'd like to believe we are still probably catching up and should be catching up, rather fast would be, say, on the regulatory side, RegTech, very specifically. The platforms are there. I see the proliferation happening, but the adoption needs to be much faster. Those areas tend to be, slightly given, behind, the continuum in terms of adoption, as against the growth-driven technology adoption that we typically do. If I may also move just from West to the rest of the world, I'd like to believe that, we are probably far ahead of many a country in Southeast Asia in this aspect, in all the aspects, if I may, especially in the adoption of technology for investing, technology for banking. China, of course, is a different bit altogether. I'd like to believe that, probably China is even ahead of West in many an aspect. And, we should benchmark ourselves in different areas to different geographies and different countries and maybe even different entities for us to actually pick the best the world has to offer. And what India provides best is the scale, it's the talent, and definitely the youth, which has the ability for a faster adoption and taking it forward. Mayank.
Shrikant, that is very interesting. I think so far, if you were to rewind 10, 15 years back, the world would look west towards, what's the best out there in financial services, especially when technology is concerned. I think what I'm hearing is, if you put India and China together, probably it's time to look east in terms of, what sort of innovations can happen, especially when technology is used to provide both in terms of access or in terms of convenience. These are on these aspects. It's probably time to look east for a lot of financial services adoption at scale. On those aspects, we would be probably, along with China, starting to become benchmarks on it. Maybe if we shift gears to Vikram, who has also looked at this from both end consumer perspective as well as a service provider to a lot of financial services entities. Vikram, how do you see with the kind of services, with the kind of transparency on credit that you can show to the individual themselves, to the intermediaries that are use it? How do you see the customers responding to this disintermediation of information that you're doing?
Sure. Thanks, Mayank, and good afternoon, everyone. Pleasure being a part of this panel. I think, Shrikant beautifully covered, and you then, kind of briefed very well on the transition of, the face of tech moving from west to east. And this is clearly evident from a lot of things which China and India has been able to do, which now, if you look at the Western world, they are now evolving to that level. So that's something which is quite interesting, the way we are moving our ecosystem. Having said that, since Experian is a data company, it's a company which has strong analytics platforms and presence or a practice actually across the globe. I will kind of share my thoughts around how technology is impacting data, and a vice versa piece, that how data is getting used through technology. So I'll kind of share my thoughts around that, at this point of time. So, if you see largely, navigating the varied landscape in the business of finance requires a deep understanding of customer needs on both the ends of the spectrum. It also demands that lenders rethink their data sources and recalibrate credit models to better understand current customer profiles. For example, today the financial institutions have a huge amount of data, which if interpreted better and in real time, will turn out to be the foundation of innovative products, which can be aimed at mass market to maybe increase financial inclusion, or just simply reduce cost and pass that benefit to the consumer. So let's take an example here. For example, the example of account aggregator framework, which we are now witnessing a huge shift in the future that account aggregator framework hopefully will bring. So what we are looking at is that the account aggregator ecosystem, when fully implemented, can help generate credit information from individual and small businesses, helping them become eligible for loans. Now, what it essentially means is that this also means that we are getting people into the formal credit ecosystem. So just an example here. So the working capital is often not available to small businesses because of information asymmetry. So if a business has a digital footprint of its own, from payment made to vendor, purchases made by consumers of invoices or taxes, that information can be used by a lender to make a decision to lend to the MSME on real-time basis, which is very, very important. And which means that there is a small trader can concentrate on business that, then planning for months together in advance to take a loan for an upcoming festive season, and stop spending endless hours collecting documents, be in and out of a bank branch, doing formalities. Not to mention that it also eliminates, a large part of this ecosystem where they are so-called consultants who play a role in the banking system, helping these small traders get those loans passed, will also get eliminated. So which means that the entire ecosystem will become, far more efficient for an end consumer, be it a retail consumer or be it a SME, to get that, access to credit real time, faster, at a lower price point than what it is available right now.
Vikram, this I'll probably do leading question. I think this sounds very intuitive, and it sounds very simple to move ahead, given the infrastructure is already coming in place. We have GST. You should be able to get all this statement, understanding of a small enterprise. We are getting more data. Why is it not moving at the pace in terms of penetration, especially amongst the underserved segment, as it is set out to be? What are the challenges that you encounter on a day-to-day basis in order to have the tech and data reach the potential that it has?
Yeah. Mayank, if I have to say, I will divide it into two parts. One is, as I mentioned earlier, the asymmetry of data. Multiple data sets. For example, GST is a very different data set than from a bank account data, than from the bureau data, which is available with us as an example. So there's a asymmetry of data, and getting all of them together where someone can collate it and read it in a more legible fashion, and more importantly, find output coming from that data. So the challenge remains is that how do we, one, get all these data together and get something which is legible output. The second important part around this is not only about this, it's about the security of data. So today our challenge, or a big piece that everyone is trying to overcome, is the risk related to cybersecurity, is the risk related to compliance, is the risk related to third party automation, resiliency, data privacy, all that. So all that has to be also measured simultaneously for this data to be available, to be used by multiple entities. Of course, this also needs some level of regulatory blessing, which means that the regulator has to come and say that outside of the the licensed entities, which namely is banks and NBFCs and so on and so forth, what is the role that fintechs can play in this? While they might not be licensed, but if we have very strong ring fencing around data privacy, data security, and all that stuff, what is the role that they can play? And I strongly believe that if you have to have that last mile connectivity, if you have to have that large scale presence of financial products, and a unique example in this case, Mayank, is, for example, the micro ATMs or the AEPS led thing. Bank correspondents, if you look at it, are in every nook and corner of the country today. They are the ones who are spreading the banking services, if you genuinely ask me. So same way, fintechs will play a pivotal role in this technology enabled financial inclusion, and of course gathering of that data, using that data for the purpose of a consumer.
Very interesting, Bikram. Maybe I'll move to Pankaj. Pankaj, you are sitting at the cusp of using both the data and using the technology. So you've spoken to someone who masters on the data and someone who masters on the technology. You're putting this together, bringing it in front of the consumer, right? How do you see the consumer experience changing and evolving with time? Because what you are competing with is not really just another aggregator of services, but really the experience that is being provided by other retailers almost, like an Amazon. How are you looking at the data part of it in terms of its maturity, and how are you looking at the technology part and its readiness to provide a similar level of customer experience?
Sure. I think thank you, Mayank, and very happy to be part of this group. Thanks, Shrikant and Vikram, for your views. So from Bank Bazaar perspective, to be very honest, right, what we do is marry the two, Shrikant and Vikram. We have data at our end with Vikram being there and then Shrikant being there from a technology standpoint. So normally what we do at our end today, consumers, Mayank, has been becoming very demanding, right? The patience level of consumer to shop has decreased significantly, so they want an experience which is like click of a button, and whatever you do on Amazon, you do on Netflix, they are also expecting the same kind of a consumer experience to be delivered on a BFSI product, which had, if you look at from an inception from 2000 to 2020, it has a long tail, right? You have documentation, you have KYCs, you have bank statements, and then you have, credit offtakes, which happens through Experian or somebody like Seville in that data symmetry formations. So what we have tried to do, I'll tell you from a consumer experience perspective, I think in a very broad landscape, I'll tell you the 4Cs model have changed to a 4A model. Today, anytime, anywhere, anything, and anyone. I think that's the new mantra that the consumers operate on. So he doesn't have a patience to go to a bank branch or to go a place where he can go and give up documentation. So today, those 4 form factors have changed. So everything is online. Everything consumers want today, right now, right here. Choice, he wants to see how many products I have, or a click of a button, I want to see 10 different products with 10 different variations on interest, processing fees from a retail loan perspective. The great news, I would say a brilliant news for the country, is that the digital infrastructure is in place, right? You have got data, you have got internet connectivity. What we had 250 million people accessing internet in 15, we're expecting 900 million people expecting that internet connections in maybe 3-4 years from now. You have sound digital identity frameworks, right? Which is to video KYCs, eKYCs, that frameworks, thanks to the regulator, has been built on the platform. So you ride on digital infrastructure, create a digital identity. What Vikram rightly said, now you have, account aggregators, which is coming like digital information, where a symmetry of the information can be formulated across the pieces. So right from a mutual fund to an insurance, from a bank, you can access the information and provide a package solution like a socket pollution to a consumer. And the last one, you rightly said, today payments, UPIs, NEFTs, it's just there, right? So you don't have to wait for any of these sourcing modules to, reflect upon all these 4 levers which were missing in some part of the story in the last 10-15 years have come to a common place now. So I think the 15 billion buyers that we had maybe in 2015 on online, today we're expecting about 400-500 billion people transacting online. This is as simple as that. That's the revolution that you're seeing. So we call it as a digital tsunami, right? So what Bikram rightly said, still, if you look at just a data point, right, on a cards, I'll just give you a very simple data point, which is the flavor of the nation right now with the ecosystems building up. We have 3.5% population getting a credit card, right? US, it's 300%, right? Every consumer will have at least 3 cards, and it's like a 300%. China is about 42%. So we are nowhere close to what the market globally operates on. So there's still, I would say, the marriage has happened, but the disruption still, I think in the next 3 to 5 years, you'll see a huge disruption happening, even the way consumers opt for these BFSI services. So today, I'll tell you very, very simple put. What we were sourcing physically maybe a year and a half back, today 80-90% business is digital. Click of a button, I'm able to source a card, a personal loan, and that too without documentation. What Vikram and the team has built in, from their perspective, are able to give him a paperless experience. And what Shrikant and our teams have built in, maybe it's a contactless experience. So I think these two have come up a long way thanks to the regulator with video KYCs coming up, thanks to the regulator with key KYCs coming up. Aadhaar is an open-ended, I would say, source you can generate from the consumers this thing. So I think these 3-4 factors have really enabled a huge disruption to come. Experience is amazing. So I'll tell you a very simple example, Mayank, in a very simple term. A guy today can apply for a card on a home loan, or even not on a home loan, I would say a personal loan, within 60 seconds, right? It will not take more than 60 to 75 seconds for a transaction to go through, which used to take like, an entire day. You collect your documentation, somebody will come to your home, do an OSP. That's the kind of friction which was there. That has disrupted in the last, I would say, 14 to 18 months. I know I should not say, but COVID really brought that disruption, that acceleration in the digital adoption, what Shrikant was talking about. I think these kind of incidents change the landscape completely. And regulator also has been very, very supportive in the last, I would say, 10 to 12 months of operation. So I think that's an overall view that I can, provide for this particular entity. But I think the times are very exciting. We have just touched on, I would say, tip of an iceberg that we're sitting on. And I'm hopeful that this disruption, when we see after 3 to 4 years, we'll see like 40-50% penetration on cards, 70-80% penetration on PLs. And what Vikram rightly said, the financial inclusion will have a huge step up because of this fintechs. And look at how your fintech space and your, I would say, startup space in India is growing, right? You already have about $12 billion in this year itself, which was like 2x of what we do the entire year. So I think these are some of those, changes, the landscape changes, the ecosystem changes, which combined, put together, would take us to the next level. That's my view.
Pankaj, what you have described is the opportunity staring in the industry in front of all of us to really provide access to financial services, make people's lives better. I had a question. I think we discussed a lot about infrastructure being there, and most of the infrastructure in India is actually created as a public good, right? So everyone has access to identity. Everyone has access to UPI. Everyone will now, with account aggregator, everyone will have access to data provided the consent is given. So the question that I have is, technology is becoming like a public good. The infrastructure is becoming like a public good, which is available. What is going to be the differentiator? Is it going to be the experience, which is again enabled by how you apply technology? Or is it going to be data? Because data is available with everyone, but how do you use this data becomes an important differentiator between all the players who have access to the same public goods. What's your view on this? How do companies thrive when information is becoming so publicly accessible?
Yeah. So I'll tell you, my view is very, very clear on this, is that data is an enabler, same as technology is an enabler. But the outcome of these two put together will be an experience. So I think whatever you do on data, you have to enable a contactless transaction, a paperless transaction, with whatever data fields we can look at. Today, we are not able to underwrite, a lot of banks are not able to underwrite a lot of consumers because of the non-availability of data in certain formats. What technology will do is create that symmetry for the data submission, which has been done by somebody like Vikram and the team, right? So I think these two, when they get married, right, from an input perspective, the output will be an experience. Today, consumers are expecting the same experience, you rightly said, on Amazon. But today, there is no credit offtake which is happening on Amazon. Today, if you look at buy now, pay later, on the go, you're able to get a credit offtake and you're able to buy a product, even from a financial inclusion standpoint. So I think these experiences are, I will be very, very honest, the checkout is something that you have to focus on from an experience standpoint. The time taken to transact has to reduce significantly. You can't operate at the same old legacy issues or the same old legacy tax. So what we are seeing is that what you deliver in a Netflix or an Amazon, you have to deliver in a BFSI. There is no two way about it. Consumer will not wait. He'll just adopt the technology. And Shrikant was absolutely right. That adoption is taking the next leap, across the board. And we are also seeing it at our end that, consumers are coming, 20 million consumers every month is coming on the platform, transacting. So I think these are huge data points, and these enablers will take us to the next level. I think that's my view.
So essentially, we need to appeal to the instant gratification era.
Yeah.
At this stage. Point well taken, Pankaj. And maybe we are in the last 2 minutes. A quick, rapid fire question to all the three of you in the last minutes. Could you tell me one opportunity that technology is making you stare at today, and one challenge that you are seeing? What is the biggest challenge that is keeping you up at night, especially when it comes to technology? Shrikant, maybe we start with you, and then maybe Bikram and Pankaj.
It's going to be again a cliched answer. My apologies. It's going to be security, data security. It is, exponential growth in data. Obviously, whilst it is going to drive a whole lot of businesses going forward. Actually, it will also drive the business of data security itself. But definitely for any, organization, whether you're a fintech or otherwise, that's definitely the one that everybody should be watching out. And we put probably disproportionate amount of effort to make sure that happens. But in terms of the opportunity that it's providing, with the tech and data together, just a few things, sorry, it may not be a rapid fire to that extent. Just give me a minute on that, Mayank. I think beyond the experience itself, I think people have started to look beyond. I think, ESG is a classic example in terms of, irrespective of how well you do, are you driving ESG as an agenda or not, is a very important item. Engagement beyond experience, extremely important. 3, I think ability to partake in your end consumers' actual goals, irrespective of whichever business you are in. I'll just give you a small example. You mentioned a little while in your opening address that, why does mutual funds take 3 days, for you to get your money back, whereas they will take the money immediately the moment you want to purchase it, right? We crashed the timelines to, 1 day now. That is also something that, one may not be very impressed with, right? So the idea is how quickly can we go to real time? So that, to me, the experience might be great in terms of giving you the ability to redeem, but the partaking in your business journey to actually getting the money on hand is a business KPI, right? Another example could be, typically a broker would take about 10 to 15 days for them to get the commission after they sell, end of the month. Can you make that happen within the day, just like people like us who are probably employees get our compensation end of the month? On the point of, anything to do with geography, again, if you move to China, for instance, you can redeem your investments literally by walking to a Coke vending machine. So you're not paying cash, you're redeeming your investments and getting a material item in return, right? And that is absolute fungibility. So to me, in terms of the opportunities that, we are looking at is going to be well beyond just the ubiquitous availability of data. Experience, I think, is the engagement. It's about our ability to partake in the consumer's journey and actually accomplish his end of, his or her end goal in itself, right? Beyond that, definitely the ESG aspect, something that, we cannot ignore, the amount of footprint that we leave behind, the social engineering aspects of it, even patriotism to that extent. I have seen many an example of organizations and entities building, business propositions specific to the geography that they belong to. And it is definitely in a good state for a developing country like India.
Yeah. Vikram?
Yeah. So to the point, what keeps us awake? Let me put it this way, that, we look at risk in 2 parts. One is the traditional risk, which includes your security threats and system failures, and other being the full spectrum risk, which results from inefficiencies in the IT process and technology. Now, if we have to look at it, Mayank, the bureaus play a pivotal role as the backbone for the information to go to a bank or a fintech partner real time for a product or a service to be delivered. And in middle of all this, while we need to ensure that we have our uptime all the time, actually, it can't be that, we have the liberty or the a benefit of having any kind of downtime. It also is around the fact that, data privacy and data security is paramount, because we not only are regulated, but we also have moral obligation, to ensure that this data is secured. We can't have scenarios where this data is floating around in the market. So for us, these are the 2 large pieces, which, we always are very particular about. Not to mention the fact that how do we now further enrich this data? For example, time and again, we've tried, our luck with the regulator, and we are still in discussion with the regulator that today, the bureau is allowed to only keep that data which comes from member institution, which is banks and NBFCs. But can we have, alternate data also coming in that same report? Because that is enrichment of data for someone to take a call on lending, on onboarding, whatever the case might be. So that's another big piece, which kind of, keeps us on our toes, that how do we enrich and make this data more usable for the counterparties who are, working with us.
Yeah, so I think my view is, I think I echo what Vikram was saying. I think data security and privacy is a big, I would say threat. And I think adding to it, maybe a risk management practices, right? With the new kind of flows coming into the system. Nobody has underwritten those kind of people so far. And so that is something that, really makes me this thing, that how this flow will look like in the next 3 to 5 years. Will the banks and the institutions get a comfort around it? Because nobody has done it so far, at that scale. So I think that's the first piece. I think from an opportunity sizing, I think I view the penetration levels from what it is today. I envisage that it has to be a multiple multifold growth to happen on that side. That's a huge opportunity. And if it does it, you can see this 5 trillion is just a tip of an iceberg for the country as well. So I think that's my view.
Thank you, everyone. Thank you for such an engaging discussion. In the interest of time, I don't think we'll have the luxury of summarizing the discussion. A few points come out clearly. The opportunity in terms of penetration has just about begun. There is a lot of innovation which is happening. Public goods are available which enable technology to run the way it is supposed to and create a great experience. I think the opportunities are manifold, but it is important to make sure that, as trustees of a lot of information that we are carrying for the consumer, we are trying to protect it, and we are trying to make sure that that opportunity gets materialized while addressing these concerns. Thank you very much for all your comments and participation in this. Arnab, back to you.
Thank you, Mr. Jha. Thanks for the wonderful moderation, and we're really thankful to Mr. Srikanth Nadella, CEO, KFin Technologies Private Limited, and it's a wonderful office room that we can watch from here, and nice flowers, and it's really wonderful to see that. And of course, Mr. Pankaj Bansal, the Chief Business Officer of Bank Bazaar, we are really grateful for your time. And Mr. Bikram Singh, Head Consumer Business, Experian India, thanks a lot. I hope that, of course, this time we have done it in the digital format, but usually this is our flagship event that we do it in Mumbai in ITC Grand Central. So next year, with all the grace of God, hopefully we would be able to do it physically. And I was just wondering that what is your this is the new segment that we have introduced this time, because we have never dealt with fintech before, and I hope that you have loved this session, and we look forward towards your guidance and support to take this forward from the beginning of this journey. Thank you all. Thank you all. Thank you.
रामू, 2 चाय दे यार।
अरे नहीं यार, एक चाय कॉफी।
इसको 30 डिग्रीज कर देते हैं।
अरे नहीं यार, 45 डिग्री सही है।
इस बार मनाली चलते हैं।
नहीं, गोवा।
सच है, we Indians disagree on everything, but we agree. SBI is the banker to every Indian.
अरे SBI कॉन्टेक्टलेस डेबिट कार्ड, सही भाई, I agree.
SBI का वीडियो KYC सेविंग्स अकाउंट सही है यार, फाइनली आई एग्री।
SBI से ट्रैक्टर लोन लिया, पाजी ये 100% सही किया।
SBI का होम लोन, जानू, this time I agree with you.
आप भी अग्री करेंगे। SBI is the banker to every Indian. बाकी बातों पर लगे रहो।
मुंबई,
चेन्नई।
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high.
the nation's trusted bank, SBI, the banker to every Indian.
रामू 2 चाय दे यार।
अरे नहीं यार, एक चाय कॉफी।
इसको 30 डिग्रीज कर देते हैं।
अरे नहीं यार, 45 डिग्री सही है।
इस बार मनाली चलते हैं।
नहीं नहीं, गोवा।
सच है, we Indians disagree on everything, but we agree. SBI is the banker to every Indian.
अरे SBI कॉन्टेक्टलेस डेबिट कार्ड। सही भाई, आई एग्री।
SBI का वीडियो KYC सेविंग्स अकाउंट। सही है यार, फाइनली आई एग्री।
SBI से ट्रैक्टर लोन लिया, पाजी ये 100% सही किया।
SBI का होम लोन। जानू, दिस टाइम आई एग्री विद यू।
आप भी अग्री करेंगे। SBI is the banker to every Indian. बाकी बातों पर लगे रहो।
मुंबई मुंबई,
चेन्नई चेन्नई।
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Good afternoon, ladies and gentlemen, and welcome back again to the Financial Market E-Conclave. We are starting the Experts Roundtable on Indian Capital Market, the way forward. We have very eminent speakers with us.
Recording in progress.
Mr. Imtiazur Rahman, CEO and Whole-Time Director, UTM Mutual Fund. Mr. Sandeep Sikka, AD and CEO, Nippon India Mutual Fund. Mr. Vishal Kapoor, CEO, IDFC Mutual Fund. Mr. Amit Gupta, Executive Vice President and National Head, Institutional Business, SBI Mutual Fund. The session will be moderated by Mr. A. Suresh Kumar, Head Treasury, ITC Limited. I would request Mr. Kumar to take this forward from here.
Thank you, Arnab. Good afternoon and a warm welcome to all participants and our esteemed panelists who have taken time out from their busy schedule to address us today. The topic for the afternoon, as Arnab mentioned, is Indian capital markets. There is no denying the fact that robust capital markets are quintessential for achieving economic prosperity. And in this space, Indian mutual funds, I would say, have grown to be a dominant participant in the capital markets. Today, they command and steer a staggering wealth of over 35 lakh crore on behalf of every investor, big and small, retail and corporate. The industry carries the burden of steering a large portion of the country's savings to fuel the funding needs of both governments and corporates alike. Given this backdrop, for today's afternoon's discussion, I would recommend that we would look at areas like understanding the growth of the mutual fund industry, the role of regulation in shaping the industry, the current dynamics and future prospects of the industry, the emergence of new asset class within the industry. While I might direct a few questions on these topics to some of the panel members, I would like to submit to all panelists that we will keep it as a freewheeling discussion and will encourage that any of you could step in whenever required to share views on the topics under discussion. So to begin, I would invite Mr. Rahman to trace for us the growth of the Indian mutual fund industry over the decades, its contribution to growth of Indian capital markets and its current positioning. Over to you, Mr. Rahman.
Thank you very much, Mr. Suresh. And it was a wonderful introduction of all of us, and particularly of me. Friends, it is indeed a great honor for me to participate in these conversations along with my other distinguished panel members, and particularly my friends Sandeep Sikka and Vishal. And we are meeting more often on a screen rather than meeting face to face. So it's a great honor. Friends, as you know, UTI has been in the capital market since 1964. In the 1964, the first mutual fund scheme came up. The scheme name was named as US 64, UTI US 64 schemes. And the mutual fund evaluations started from there. In the year 1963, then the finance minister, in order to channelize the small savings of retail investors to the capital market, they started these organizations, and it is my great privilege and honor to serve these institutions ever since from the 1998. The mutual fund as an industry is need to be seen in relation with about our India's economic growth. It is our missions, is India's missions, that we must be the $5 trillion economy. And in order to provide the sustained and sustainable capital market and accelerate the growth of Indian economy, a mutual fund indeed is playing a very, very important role. And let me give you the perspective. The mutual fund business in India started in 1964. And from 1964 till 1992, there was only one company or one institution which was working. And these institutions, along with the many other institutions like IDBI, SBI, LIC, built many institutions like NFC, Stockholding Corporation, CRISIL, ECRA. So they not only help in building the capital market, they also help the nation in building the great institutions. So you name any, these institutions have built many other institutions. And I will fail in my duty if I don't mention the name of ILFS. We also played a role in basically incorporating ILFS. So where are we now? And how the journey has been. This month, coming month, we will be celebrating or we will be completing the golden jubilee year of one of our schemes known as ULIP. This was launched in 1971 and it still survives. That indicates the resilience of mutual fund or mutual fund industry. We have another scheme known as, and I'm not selling by the way UTI, I'm just trying to say about the mutual fund perspective. And it was then master share came in. We are almost, that scheme is over 4 decades old scheme. It gives a very clear message that mutual fund was there in our country and mutual fund is going to stay with us perpetually. Then the period came 1992 when there was a complete reformation in our country, particularly in the capital market or financial sector, thanks to then Prime Minister and then the Finance Minister who eventually became the Prime Minister of the country. And the SEBI came into the picture. Since then, we are working as a team, as a unit in the industry. And we have taken mutual fund across the length and breadth of the country. And let me give you some broad number. In the previous decade, right from 2011 to 20, our industry grew by 5x. So from 12 lakh, from almost 11 lakh crore, 6 lakh crore to almost 22 lakh crore, over 22 lakh. And if you see from 2015 to 2020, the industry grew by almost 3x. So we have recorded a very, very great growth in our industry. What we provide as an industry? We as an industry, we have the product or investment opportunity for the entire life cycle of any investor. We manage over 11 crore folios and we have a system or we provide an opportunity to investor to invest through SIPs. And we are witnessing a record number in the registration of the new SIPs yearly. We are an industry we are like a daily wage worker. We declare our NAV every day. All of us, the entire industry declare our NAV every day. We are a very open and transparent industry. And as Mr. Rajesh Gopinath other day said that the carrier in TCS is like the investment in the mutual fund scheme. So TCS has produced many internal CEOs and CFOs, and therefore we as an industry, we have a track record for creating wealth for our investor. Mr. Suresh, we are currently managing around 36 lakh crore of AUM. And if you see the growth of in our AUM of mutual fund industry, and if you fast forward to 2030, probably the growth, if not more, it will be at least 3x. I'm a part of the listed company, so I can't give you any forward-looking statement either for the industry or for UTI. But the industry is playing a very, very important role, and I'm very confident the industry will continue to play a very significant role in realizing the dream of our Prime Minister to take India to have the $5 trillion economy. We need to do a lot, and I will stop here and I will request my other colleagues to add his point of view. Over to you, Mr. Suresh. Thank you.
Thank you, Mr. Rahman. You did trace out the growth of this industry, and it's been pretty stupendous, no doubt. And in fact, the amount of 36 lakh crore would represent a little over 15% of the nominal GDP of India projected FY22. So that is the size we are talking about, and your contribution, the industry's contribution to economic growth is I mean, there is nothing more to add to it, given the share which the industry is commanding. But in this journey, what I would also like to ask the panelists is to trace out, how is the investor profile changing over time? While the growth has been stupendous, is there any change in the investor profile, what it was 10 years ago to what it is currently? I mean, anybody from the panelists can, address this and trace this out for us.
So there are 4 of us are there who would like to take. Vishal, you want to take, or Sandeep? Anyway, you need to decide, Suresh. All of us can take this question.
I know. Sandeep, would you want to step in here?
Sure. So Suresh, I think it's very interesting how the industry has evolved. Today we are at, as the Sensex touches 60,000, and just way back in 1990, the Sensex was 1,000. I think, and from there things have been changing. I think one of the big things that we have changed over the years has been mutual fund. While it has been there for a long period of time, but especially in the last 10 to 15 years, things have really changed. From being a product which was a very urban, elite, or not so well understood, today it's becoming a product of masses. I think you have to understand the background, what is happening in the country. I think if Rahman talked about the economic change which happened in the country when Prime Minister Manmohan Singh came, and after that, I think India has been growing. But one of the key things that you have to see is, over the period of time, the hard assets, whether it was to real estate, gold, and the fixed deposits, which earlier used to give double-digit returns, all those things are no more attractive. There was a time, and I would not blame anyone, a lot of investors could not understand the difference between investments and savings. And when your fixed deposits can double in 3 to 4 years, you don't have to look out. Today, we have come to a situation where the interest rates are mid, 5 to 6%, the bank FDs. It's difficult to search. Last week, I was seeing the mid newspaper where all the FD rates were there. Even the bank that you would call the weakest bank, perceived to be weakest bank, that will also not give you more than 6.5%, 7%. Real estate and gold, we know the story. So what's happening is there's a big shift that is happening. As a country, we do not have social security system. People have to plan for long term.
And now mutual funds is becoming a product of choice. So it's very interesting, if I was to quote this example, which I quoted earlier also in some forums, way back in 2000, when my father, who retired from government service, when I put his entire money, I requested him to put his money in the mutual funds. A lot of people, his friends, his advisors, questioned that how can you put your father's retirement purpose in mutual funds? I mean, it's not the best things. It's risky. It's gambling. All those things, the notions that are there. And here you are 20 years later. I think my own daughter, when she gets a first stipend, she goes and invests directly into a mutual fund. So it's not only the profile, but also the way people are seeing mutual funds and the way they are investing in mutual funds. Everything is changing. And this is with the backdrop of overall, while I think as a industry, we have 2.5 crore unique investors, 10 crore folios. But I think you have to see how the base of the capital market has been broadening and deepening. So last year itself, we saw 1.2 crore demat accounts open. Now these people, during this work from home, a lot of people started investing in capital markets. One thing is coming for sure, there is a shift of investors from bank deposits to capital markets. And capital markets, whether it's directly stocks or mutual funds, I think we clearly believe it's a matter of time. Anybody who's in capital markets will eventually be a part of mutual funds. So I think we are at a very interesting juncture. The way I think industry took, from 1990, when the Sensex was 1,000 to 60,000, it's effectively 30 years what we have seen. But I think I'm very confident we are at a stage where in next 10 to 15 years, we might be in a position to thumb the table and say every Indian household is a mutual fund investor. So I think I'll take a pause here and back to you, Suresh.
Thank you, Sandeep. Sandeep, just as a follow-on that, if you could also elaborate, how is the investor profile, whether it is largely from an urban centric or it is also started to diversify into the rural centers. What is your take, since you run a large fund house with very big distribution arm? I thought you would probably can throw some light on this.
Yeah. So I think I'm very pleased to say, not only for the company but for the industry, I think we can proudly say there are 770 districts in India, except for the 30 to 70 districts which are Naxal infected and others where you do not have all those things. Today, mutual fund industry has got investors from in excess of 700 districts in India. Number two, there's been a very big change, especially in the last 3 to 4 years. And for that, I give credit in 2012 when Chairman UK Sinha was there. I think he used this concept called B15, which then went to B30. Since beyond 15 cities, beyond 30 cities. I think there's been a conscious push from the industry, and compliment AMFI for running a very strong campaign of mutual funds. Today, I think for if you were to leave the AUM aside, because AUM still comes from a lot of HNIs, bigger cities and all. But I think as well the new investments are coming, the new SIPs are coming, it's no more, it's a question of top 10 or top 20 cities. I think today for us, I think it's maybe the first time we are seeing more SIPs coming, and maybe also this is also a function of technology, a lot of online. When you're talking of online, there is no demarcation, whether you're sitting in Mumbai, Nariman Point, or whether you're sitting in Asansol, or whether you're sitting in Vizag. So I think what's happening now, the big change, investors from across the country are coming, and it's no more a big city phenomena. And I would also highlight the fact it is the overall awareness is increasing. So two things are happening. On one side, the awareness is increasing. The other thing, today the mutual fund industry has been able to add a lot of wealth for investors. Over these 20-30 years, as Mr. Rahman talked about his scheme, there are a lot of schemes over 20-30 years. They've created so much wealth for investors. Now people are understanding the longer you stay in the industry, it's adding wealth for you. So I think it's a very big change that is taking place in the country, which is not only good for the mutual fund industry, but also good for the Indian capital markets, because mutual fund industry is converting the household saving into capital markets.
That's
just to add what Sandeep mentioned, on the kind of adaptability what we are witnessing amongst investors. Just to throw some color on the number of investors which are putting in. So at this juncture, if I speak about for the industry as well as our company, nearly 88% of the pins are contributing to the mobilization. So a lot of groundwork has been done by the regulator in terms of authorizing, with also from the association industry body, in making sure that the proper awareness is being created amongst each and every investor. And we are seeing some bit of shift, a lot bit of shift, in fact, from being saver to investor. And that is the reason why this kind of money mobilization is happening. Also, people have understood the virtues of long-term wealth generation and creation, which happens through mutual fund. So it is not only, the urban-centric phenomena what we used to witness a decade back. Now it is expanding all across the country. And to that extent, I believe each and every asset management companies have done their bit in terms of making sure that our footprints are there in as many districts as possible. So we believe it is still the tip of the iceberg when we compare our numbers. And as Mr. Rahman mentioned, while India is destined to be a $5 trillion economy sooner than later, but the kind of potential when you look at the asset management industry, and when we compare with the Western world, where the asset management industry size more than 100% of the GDP, or the banking size, we are just a fraction of that. When we compare us with the banking AUM, we are what, 22-23%. When we compare with the nominal GDP, as you mentioned, we are only 15%. And so even if we take, say, 50% kind of average at so ideally our size should be double from what $500 billion what we have, can easily become $1 trillion, given the banking AUMs of $2 trillion plus, economy also touching 3. So there is a humongous potential, and looking at the current penetration levels, which are still in single digit, we believe there is a long way to go. And I can only say that the direction is right. The only thing which we have to increase is the gradient through where we have to keep on venturing into newer areas. Focus should be on the market making, and I believe each and every AMC on their part are making sure that we keep on bringing new investors into the fold.
Thank you, Amit. It is very true that the reach of the mutual fund industry has been growing over the times, and the testimony to that is the fact that SBI Mutual Fund has been successfully been able to garner more than 14,000 crore in its recently closed NFO on the Balance Advantage fund. I know what is so surprising, Amit, is the fact that at a time when markets are at all-time high, and the noise is somewhere that caution needs to be exercised by investors, and they need to be careful before plunging into equity markets at these valuations. Still, SBI has been able to go ahead and garner this kind of a corpus. It's something, a testimony to what investors believe in the rationale of investing, channelizing their savings through mutual funds. So in this context, Amit, it would be really great if you could share some of your experiences in this journey of this NFO, and also the investors' mindset which you have gleaned from this process. It will really help.
Yeah, sure, Suresh. In fact, just to give a perspective, in this NFO, we got around $2 billion plus kind of a number. In fact, to be precise, around $2.15 billion. And so we are frankly overwhelmed with the kind of support and trust which has been reposed by our investing community, channel partners, and all the stakeholders in making sure that we create history. So exactly your point on the markets, that is the reason why we get this kind of a mobilization. For this whole year, we have been focusing on providing solutions based strategies, or focusing on hybrid, given the way markets are, and even debt is not doing that well. So investors are generally looking for those kind of strategies where there is a complete flexibility in the hands of fund manager to move asset, their investment or portfolios between equity, debt, and arbitrage, which is the third portion out here. And another thing which has played, for us to our advantage, and which is a major differentiator, is our parent State Bank of India, with the kind of reach which State Bank has across the length and breadth of the country, and also the trust which it gets from the investor, make sure that we are well covered across our length and breadth, and covering the whole country, not only focusing on India, but in real true terms focusing on Bharat. So this is a NFO in lot many ways it is historic. Not only one intermediary, which in this case State Bank did $1 billion plus kind of a mobilization, but even when we speak about the other channels combined on the distribution side, we have got $1 billion plus. And to add to it, from the institutional segment, which we cater to our HNI clients, to our family offices or active treasuries, we could do around $150 million kind of a number. If I have to give you some color about the kind of reach what we have created, rather than only focusing on market sharing, the endeavor always remain to keep on expanding the pie. 88% of the SBI branches contributed, which means 20,000 branches giving money, mobilizing money for us. But 85% of the pin code, we got contribution from, and as Sandeep mentioned, only 32% of the money has come from top 6 metros. Remaining money has come from the True Bharat, and it shows the acceptability of mutual fund as a concept. People are looking for strategies, good solutions where they can create a wealth over longer term. They have faith. That the main differential out here is what kind of a reach which you have on the distribution side. How are you reaching your customer? How are you able to highlight the kind of philosophy what you have? And as SBI Mutual Fund, our thoughts are very, very clear that SLR is the core of our portfolio management, which is what we have been taking to our investor and convincing on them. And the other thing is, we focus rather than only on return, we look at the superior risk-adjusted consistent return. That is something which we bring on the table. So investors thankfully have that kind of a faith and trust, and especially the way we have navigated the last couple of years, which have been very turbulent for the financial market, is culminating into all this. But the real differentiator, let me again reiterate at the risk of repetition, is our parent, State Bank, and under the current chairman, which used to be our MD and CEO a couple of years back, and he is the man who is behind all this turnaround what we are seeing in our company. Long way to go. I believe we will see more such records coming from other players. Idea remains, it is not the numbers, but the number of investors which we have to get unfold and make sure that we keep on providing the right wealth generation tool, keep on propagating the long-term investing virtues, and how people have to be very, very disciplined. And to that extent, we are seeing a welcome change among investors. If you look at the last couple of years, not only debt market, even equity markets have been very volatile, but this SIP trend is continuing, and that is how we are matching the might of FI's outflow at times. In a lot many manner, we are moving in a very right direction, and we believe things will only improve. As I mentioned, despite the fact we have shown very decent growth as an industry, it's still a long way to go. Even if we reach a 50% of the banking AUM first and then the GDP, I believe the industry could be much bigger than what we are looking at this point of time.
No, sure, Sandeep. I'm sure industry will reach to greater heights, but I should admit that you have been very modest in attributing the success of the NFO largely to your parent. I'm sure SBI Mutual Fund as a team has also had a large part and role in this whole process. But what does not go unnoticed is the fact that SBI Mutual Fund as an institution have catapulted themselves to the #1 position in the mutual fund industry over the last 3 years. And I'm sure there has been a very planned and thoughtful journey. Is there anything you want to share with us on this journey, Amit?
So frankly, Suresh, we are still the learners. Idea remains that we need to make sure that whatever the true potential of this country is, we need to realize that we are seeing an increased speed of financialization happening. Sandeep mentioned about there is a big shift which is happening from fiscal assets to financial assets, and I believe each one of us have to shoulder responsibility in making sure that we keep on popularizing the concept as much as we can. While we keep on focusing on mutual fund, there is another big area on the private space, which is PMS, AIA, which are again gaining a lot of traction. So our idea remains that anybody who is having money, who is maybe starting his career or different part of their life cycle, or corporate investor, we have to keep on providing solution. Imtiaz sir mentioned about the kind of transparency we have, and in fact, in terms of transparency standard, in terms of the SOPs what we have, we are the best in the across the world, second to none. Whether it is about the daily NAV or giving the redemptions on T+1 or T+3 in case of equity. So the kind of practices what we have is top class, world class. The disclosure norms are against the best. And the strength of this industry comes from the fact that we have been always focusing on long-term vision, long-term strategy about the industry, propagating only about long-term solution. And this is something which investors are taking. Now, coming to SBI, for us to be number one, it is a rightful place, and which is what has been shown by our chairman. When he was RMD, because when your parent is the numero, in the banking sector, having a quarter of the whole banking industry, it is very, very natural for us to keep on following the footstep of parent, while it is too big a shoe, to fill. But idea remains, we have to keep on treading the same path and make sure that we are broad basing our investor base. We are entering into newer areas. And still, the fact of the matter remains that there are not many investors, whether on the institutional side or on the retail side, which are still not tasted, the advantages of the asset management companies and mutual fund in particular. So our endeavor remains from the company side to keep on venturing into those segments, those areas, those institutions and entities which are still, investing or sticking to traditional method. We have to, take our solutions to them, make sure that we make them aware about their strategies, what we follow, and so they can also reap the benefit of mutual fund and the benefits what we offer.
Thank you, Amit. Amit, while you have traced your growth and the reasons how your AUM has grown steadily over time, but what also does not escape the attention is the fact that fintechs have started of late taking a lot of interest in the financial sector. Till now, they have been only on the largely wanting to break into the payment space and the lending space to some extent. But even on the mutual fund segment, I see a lot of interest from the fintechs. The industry is also buzzing with a lot of new entrants, and many new firms have got their license and are rearing to launch their offerings in the market. And investors also equally, the base of investors and the number of investors have also been increasing, as Sandeep rightly mentioned, that the other avenues are drying up and capital market is what everyone is looking forward to create and grow their wealth. In this regard, I would probably invite Vishal and also Sandeep to share with us, their understanding of how fintechs will contribute to the industry, and are they being looked at as disruptors, and how would it upend the position of the existing players? Vishal, over to you.
Thank you, Suresh, and thanks everyone for having us here. Suresh, you mentioned about fintech, and clearly that is one of the trends, not just in the BFSI space, but across many aspects of industry, really retail-facing industry. And clearly they've had their impact on the BFSI space and in the investment space, in the wealth management space. But I'd also like us to trace some of the other broader trends, which may make this one of the components. So within the larger framework of what's been happening, how is this sort of fitting in? While yes, it is a large component, but maybe we also look at what's happening in the macro in that sense. So if you look at let's say the decadal trend over the last 8-10 years, what's been happening? Something Sandeep mentioned fleetingly, which is that savings, which has always been a strong point for India, has been getting more and more financialized. Means that while a larger proportion of household savings in the earlier decades was going into physical assets, now clearly financial assets, including capital markets, has become the larger portion. And that's a secular trend, even before fintechs come in. And that's something we must recognize. So as the economy grows, more and more financialization of savings is bound to therefore keep driving up broader capital markets. Of course, mutual funds is a part of that, and clearly we are a very big enabler in helping in this process, but we are still a part of this process. So that's a large trend we must keep in mind. And many of these new technologies really rides on top of that trend in some ways. Right? Now, behind this, which is why is it that financialization seems to have now sort of got past this tipping point? And what's the quality of this trend, if we were to call it that, right? When we talk about quality, I think, the highest quality we always look at stands for, the AAA. And I made that same acronym for the quality of our growth in terms of how financialization is happening. So what are the 3 A's that is driving this trend? The first, to my mind, is awareness. Because keep in mind, unless individuals are aware of the choices that you have, how do you participate? And clearly over the last decade or so, and with the help of digitalization and fintech and, in general media access, I think awareness has exploded. So you do have now more choice, whether it is buying a product on an e-commerce platform, or for that matter, getting more and more literate about financial choices you have. So awareness is a big enabler for the length and breadth of the country, which is driving some of these trends. The second is access. And clearly, while physical access has always been, to some extent, more available in the larger cities, and then it's trickled down. And over the last decade, we've had enablers like B15 and B30 and many of the others. And clearly, the industry has done a lot to try and get more distribution access points available in smaller towns. I think adding fintech on top makes it a far more powerful combination, because as we all understand, and in the consumer world, access through financial, through technology, now that everyone seems to have a mobile phone or at least some form of connectivity, just allows you to, get to every corner of the country. So that's the second A, I think, which is a broader trend. The third trend, which is also very important, is this attitude. The new generation seems to be far more open to experimenting, to taking maybe a bit more risk, and therefore be able to participate and join in more modern, more evolved, I would say, products such as mutual funds, than maybe some of the traditional options, which, the earlier generation was more comfortable with. So I think all these 3 A's have combined to allow this financialization. Now, having said that, we must also be conscious of some of the potential challenges and pitfalls. Clearly, I think, we've seen the explosion over the last year and a half, right? In terms of either demat accounts or whether it is the number of people participating. And if you're coming in here for the long term and you understand a bit of capital markets and how you should be looking at, really allocation and risk, it's great. But, if you're coming in because there's been almost a very steep rally and, you think that capital markets is a way to make money, in a quick shortcut manner, then we should be cautious. So to that extent, I think there is always the flip side we have to, as an industry together, be conscious of. That are people coming in for the right reason? The majority, we would believe, are for the right reason. There's always the caution that we should have around. This is not a place to just make a big, quick buck because there's been a very sharp market rally. And therefore, you have to look at investing for the long term and come in for the right reason. But having said that, I think the opportunity clearly is that there are great products available, clearly products meant for all aspects of the, of the investing universe, whether it's a retail customer coming for the first time or a very sophisticated customer who's looking at niche products. The entire range is available through funds. It's also now providing you access. Awareness is high, and I think attitudinally now investors are in a very different place. I think fintech just sits on top to leverage part of this ecosystem. That doesn't mean that other aspects of traditional distribution have any disadvantage. So I think there is space for everyone.
Point noted, Vishal, point noted. But see, one thing, Vishal, which is probably as a trend I have observed over the last several years in my current role, is the fact that, the industry has been fairly concentrated at the top. Probably the top 6 to 7 players would have a very dominant share of the market. And from what we have seen of fintechs and how the space has evolved in the other sectors, it seems to be a winner takes it all kind of a scenario. So given these observations, I would love to hear from Sandeep. What is his take? Does he look at fintechs as a threat, or what is Nippon as a fund house doing to adapt to these new technologies or these new modes of distribution? If Sandeep, if you could kindly throw some light on this, it would be really great.
Sure. Thanks, Suresh. Suresh, I think it's let me take the last thing that you said. Do we see these companies as a threat? I think the way we see, I think there's the the entire fintech and the technology space needs to see as a big enabler for the growth of the mutual fund industry. For me, I'll pick up the words what Vishal mentioned, the AAA, the access, awareness, and attitude. And they contribute in all the three. Let me give you some data, very interesting data. I think many times we start believing that it is this versus that, or this or that binary. But I think we have to all understand these are collaborations. So let's look at the last year saw the highest number of demat accounts being opened, almost 1.2 crores plus minus few thousand here there. But what did that do? That also ensured highest number of ETF investors came into the country. Now, what does that convey? That conveys it is you cannot see anything in isolation. I mean, with the Zerodha and the others opening demat accounts, with the demat accounts, a lot of people buying ETF, and who's the beneficiary? The entire Indian capital market, including the mutual fund industry. So the other way to look at it is, I think technology will play a very big role, especially now I'll take the second A from Vishal, the access. Now, what that is doing is basically I think it is helping us go deep. It is reducing the cost. And for us, I think we clearly see, I think it's not only as a Nippon, but as an industry, that I think whatever is good for the investor is long run is good for every stakeholder. So if today a particular product, irrespective of the size of the asset management company, whether it's to the distribution access, whether it's physical, some people will like physical, some will like digital. I think our job is to give all the choices to the investors, and I think let the investor decide. I think I have very strongly believed for any long-term growth of a company and industry, you have to keep the investor in the center, and all strategies have to be built around that. And for me, digital just becomes one of the new access points. Now, will it get further efficiency in the system? Answer is maybe yes. Why only fintech? I think I see in India, we have 45 asset management companies. In US, there are 4,000 asset management companies. The fact remains in India, we talked about all the growth that we talked about even today, 2.5 crore unique investors are there. And Suresh, you'll be surprised. In India, we sell 2 crore two-wheelers every year. Now, imagine today, somebody who's buying an insurance policy for a scooter or a bike. Why should that person not be buying a SIP? Now, all these people will get converted, and technology is going to be an enabler. And let me go back to with all the things that we keep talking about technology, whether Uber or Zomato, it has only helped the growth of the underlying businesses. Uber is basically the biggest platform of drivers in the world. It has created employment. It is still buying cars. It is Zomatos and the Swiggies still have to go to the restaurants. Will an emergence of some cloud kitchens, will it stop the other restaurants? Answer is no. Same, I mean, a lot of this euphoria about Netflix and others. While we have OTT, but DTH does not stop. The PVRs do not stop. I mean, it's very interesting. I think we have to live, we are living in a world, it has to be not, everything cannot be binary. It's this versus that. And I think for a lot of us in the industry, we strongly believe mutual funds will require both a very strong digital access, the contribution from fintechs will be very high, but there will also be a need for physical infrastructure because we are right now living in a society, while we have every year 10 million new people coming to the job market, but they will have savings maybe after 10 or 15 years. But presently the people who have the savings who are 45 to 50, they may not, they still want a physical access. So I think we are living in a world where both will coexist. What happens, Suresh, when you invite 3 of us in 2035 for this seminar, maybe we can, give you a different picture. But I believe for the next 15 years, I think both will coexist.
Sandeep, just to add what Sandeep mentioned, what we strongly believe, the concept is more of a digital where you have to have your physical presence. So to make sure that at any point of time, investor is looking to meet you, want to have a one-to-one kind of a meeting and want to understand about the, some of the strategies and all, you have to have a physical presence. At the same time, the digital technology is more of an enabler in making sure that accessibility is something where there is a total convenience for the investor. So it will go hand in hand. It will only expand the market. So more the companies, it is merrier for us, and we will see a lot of new concepts and all. And it is only for the benefit of the industry per se.
Thank you, Amit. Both Amit and Sandeep definitely, given their positioning within the industry, are putting up a brave face in spite of the threat from fintechs. So that's very nice to see. But the fact remains that the way the fintechs I have seen operate or I've seen evolve in other sectors is first is to get the customers onboarded by distributing mutual funds and distributing financial products, and thereafter come out with the product themselves. So as they believe that with so much of customers, they understand the customer better. That's how these people have been evolving. So let's see. I think.
Suresh, I'll just add here to it. Sorry for interjecting. I think it's not a brave face. I think I would put it very simply. I think I'll repeat, whatever is good for the investor, whosoever provides that will survive. I think why only talk about fintechs? I think within the industry itself, if you're not able to add value to the investor will dump you. So I think the point what I'm trying to make here is it is not digital having a platform or having a product at 1 or 2 basis point that cannot make you win in long run. I think you have to continue adding value to the investor, and that threat does not only come from the fintechs, comes from anybody who's targeting the savings of our investors, and that could be our internal the various other AMCs who may not be fintech or non-mutual fund industries also. So I think I would again stick to adding value to the investor. If whether we are fintech or not, if we don't add value, we can't exist.
No, well said, Sandeep. In fact, the role of mutual funds in educating investors of the various options available to them away from the traditional methods of only fixed deposits, I think has been wonderful. In fact, the only competition to fixed deposits, which are considered a safe haven asset, used to be deposits offered by NBFCs. And we have, over the past several decades, seen the kind of turmoil that industry has gone through and the sufferings which it has caused on the investors. But I think the mutual funds having come into play have done a tremendous job in channelizing all this in the right segment and right sectors. And
So just last point on this is very interesting. Today morning when Sensex touched 60,000 on CNBC, Anuj said just one thing. He said, I think it's a one-way market is going up. It took 30 years for Sensex to touch 30,000 and it took 3 years to touch 60,000, next 30,000. I think he actually said a very interesting thing, which is very important. I hope a lot of people who don't leave their jobs and start thinking money making is very easy by coming to stock markets. And why I'm trying to touch this point is I think mutual funds are with the professional approach and helping the investors to create wealth. It's also important to check the euphoria because the retail investors many times get carried away with what is happening. And that's why the human intervention, and I'm using here the role of the advisors, can never be undermined. It will play a very, very big role.
No, point noted, Sandeep. Sandeep, see, on the growth of industry and how the various new entrants can also be accommodated is to increase this savings pool which is coming into the capital markets. So in that regard, what comes to my mind is the household savings to a large part is also locked up in gold investments. So somewhere, the efforts of both the government and the industry to monetize this household saving can also catapult, the Indian capital markets to greater heights and also be a source for funding the various initiatives of the government, especially the Atmanirbhar initiatives and all. So in this regard, I would invite Mr. Rahman to share his thoughts on what further can be done to channelize these savings, household savings into the capital markets. Mr. Rahman.
Suresh, thank you. But before that, I would like to touch on the fintech, and I support Sandeep for this. Let me share with you a life story. I have 18 plus years son, and he gets every month some pocket money. He has started using the fintech to do for SIP. And whenever the NAV is down, he comes back and tells me, Abbu, 60 rupiya nuksan ho gaya, right? Because he is not being advised by anybody how to invest it. His elder brother, who is 5 years elder to him, advised him, have patience, right? So there's a big gap which is there, and therefore both Sandeep and all of them, me as Vishal are very right, that these channels will coexist. Suresh, I really do not know. I don't have a very clear answer for that. because I myself is a big investor in the gold, right? I do it. I love it, investing in the gold. We just celebrated our 30th marriage anniversary and I bought some gold for my wife. What I want to say is very important for our country to really channelize the gold to the capital market. What we have today, a lot of unaccounted money is there. I don't want to talk anything on that, but 5,000 tons of gold is there. Even 50% of this, if it's channelized to the capital market, which will provide the long-term funding to make India is indeed an Atmanirbhar, completely independent from the foreign money. We will have not less than $150 billion of our own cash. If you launch any IPO, anything, we are largely dependent upon the foreign investor to come and rescue us, right? So it's very important for us that we unlock this particular opportunity of the gold from the hard commodity buying. Can we go to the gold ETF? The industry is trying. We have not seen any momentum. I think Government of India should also pitch in. They can play some role in this, give some incentives also to the investors and potential investors. And it can play a very, very important role in really fueling and providing the long-term capital for the growth of our country. And not much, even 50% or 30%, even 33% is done, it will provide $100 billion. And $100 billion is basically meaningful money to fuel the Atmanirbhar Bharat mission of our Prime Minister. Suresh, over to you.
Yes, Mr. Rahman. Let's hope some developments happen in this space, which would channelize these investments into the capital markets. And gold is a large part of our import basket as well. It will also do a lot of good to our current account and the currency per se. Now, besides this, taking forward from here, there are also other avenues for channelizing savings which are opening up besides mutual funds. The two segments which are gaining prominence, which Amit's mentioned, was PMS and alternate investment funds. So I would invite Vishal probably to shed some light on what role these part of the segment of the capital markets are playing and how their growth is being looked at. Vishal?
Thanks, Suresh. So first off, we must understand that the minimum investment for, let's say, an AIF as an example, an alternate investment fund, tends to be 1 crore and above, right? So 1 crore and above. And if we use the rule of thumb that, you should not have maybe, anything more than 5-10% of your allocation into any one product, and even that may be very generous. We are really straight away talking about people who have financial surpluses above 20 crores. And and that really, you would have to start with and say, how many individuals or how many, people would therefore fit into that bucket. So clearly we must understand and appreciate that AIFs and PMSs are meant for a very sophisticated investor audience. Now, do they add value? Yes, one can argue that they do provide strategies that broad-based mutual funds will typically not get into. So, as an example, if a sophisticated investor wants to take a bit more of concentration risk and have a very, let's say, relatively high risk portfolios, or there are types of products, let's say, for example, absolute return funds or hedge funds, that can have an ability to short parts of the market or hedge parts of the exposure that you have. Then, those are alternate strategies that one can build through an alternate investment fund. Or indeed, now we have so many private equity offerings and, venture cap offerings, etc. So if you want to participate in the private markets, not the public listed markets that largely where mutual funds come in or come in on the equity side, then these are strategies that you can take. Or indeed, concentrated credit risk that you may want to take, distressed credit, etc. So clearly there are various strategies that an AIF or a PMS may be able to offer to you which could be an extension of the range that a mutual fund may be able to offer. And therefore, at the margin, it can add value. However, to believe that that will channelize savings for the masses, I think we have to first understand that these are sophisticated. They come in for the right reason with minimum requirements which are very high. There is a new regulation coming in which allows for accredited investors, which also has to have a minimum net worth or a certain amount of income to participate at a smaller level. So that may actually help deepen part of the AIF and PMS markets because the minimums may come down. But even then, very clearly, it is meant for the top of the pyramid. Financialization of savings, and like we discussed, and Raman Bhai just talked about the fact that the larger opportunity clearly is how do you get the real financial savings to move into to move into financial savings? How do you get systematic movement of unproductive savings to move into the productive sector through capital market products like mutual funds? And that's, to my mind, the middle and bottom of the pyramid rather than the top that we must, where the larger opportunities lies. So just to summarize, there can be added value for a very sophisticated set of customers through AIF and PMS because of the niche strategies they can run, which a mutual fund would not want to venture into because of risk and the type of profile of customers we serve. Having said that, it is still going to be the top end of the pyramid. The middle and bottom, I think, have to be served through mass products like mutual funds.
Thank you, Vishal. See, in this backdrop, I think it's also important to understand the role of SEBI as a regulator of capital markets. No doubt they have played a large role in nurturing this industry, and their role has been pretty significant, and it has also helped drive investor confidence in mutual funds. The growing AUM of the industry is also testimony to their role. In this regard, if I may invite Mr. Rahman to share his experience and thoughts on the topic, given his vast experience.
Suresh, I have and had an opportunity to work in both these scenarios. When SEBI was not there and SEBI is there. Also, I am indeed very fortunate to work with and or under the leadership of Mr. Damodar and Mr. U.K. Sinha, who eventually became the SEBI chairman at a different point of time. We as a country, basically, we are on a threshold of a breakthrough growth. And in these particular situations, regardless, not only for mutual fund, but the entire capital market, it is very important to have a very robust regulatory framework environment, which will indeed provide the confidence and the trust of investors in our capital market, which in turn will provide the sustained growth in our economy. So I would say that it's very important to have a very stable and consistent regulatory framework so that investor has confidence in us. Let's see from two different perspectives, from the Indian perspective or domestic investors and the foreign investors. So far as domestic investors are concerned, they have a feeling that yes, SEBI HANA to protect their interest. It is a very big confidence which investors should have, and people and investors have in our regulator. I haven't had an opportunity to work with various foreign investors. Whenever you travel outside world and meet any fund managers or FPIs anywhere, they repose tremendous confidence in our regulator. They say that Indian regulatory system is indeed well managed, and that always provide a lot of pride to me to learn that yes, they respect our regulator. But our regulator is indeed very progressive, very accessible. As an industry level, Sandeep has served as the chairman of IMFI. He has more experience than me in dealing with SEBI, and he is one of the longest serving CEO of his own organizations. So he has a dual experience as a past chairman of IMFI and very active member on the board of AMFI, and Vishal is also a very active member on the board of AMFI. They have a wider experience than me in dealing with the various officers of SEBI. They are quite accessible. They are ready to listen to you. They respect you. These are the very good signs which we have. But they don't tolerate any nuisance and nonsense. They will not tolerate anything. And in my own experience, on 3 occasions, Mr. Suresh, I must tell you, in 2008 and 2018 and 2020, our industry faced the credit issues or liquidity issues. SEBI and our AMFI as a trade body, they did a very, very proactive role. They spoke to the government, they spoke to the RBI and ensured that each and every investor, small or big, large or HNI, they served on time. We are the only industry which has not defaulted at all. Not a single investor is turned down. It is a kamal of SEBI that they have put in place a right framework where we declare the NAV and everything is passed through. So I would like to say on my personal behalf and on behalf of my entire body, I can take the opportunity to say that SEBI is doing a commendable job. For mutual fund industry, there used to be a lot of confusion about the products. Huge number of products were there, but generally commoditized. So investors were not able to distinguish. Now there's a classification, a reclassification of the product. Then there's a TER. Various AMCs are charging different TER. That also has been nationalized. So both for the investors' perspective, I think SEBI is doing a terrific job. For us as an intermediary and money manager, we have a lot of confidence in SEBI that at any point of time, if we need any help, SEBI will definitely will consider our request. We will always ask SEBI to give us more. One thing which I will use this forum to also share that we as an asset manager, we don't have any incentives. Everything is a cost base. TER, we need to manage the TER, only we need to charge our fees on that. SEBI should consider also to give us some incentive that if we outperform, AMC should be in a position to charge. But the request will go through the AMFI. I can't make any direct request. But in my summary, I would say that SEBI is the great regulator. And I'm personally very pleased to deal with the SEBI officials. And we would like that same level of resilience in SEBI should continue to help the economic growth of the country. Over to you, Suresh.
Thank you, Mr. Rahman. You also touched upon the point of AMFI, which has played a very significant role and also has been a bridge between the industry and the SEBI. And I should tell you, even AMFI, in all their actions, have put investors at the forefront in all their decision making. So that is indeed very commendable, and especially under the chairmanship of Sandeep Sikka, it has been taken to new heights. So that's as an investor, I should tell you, yeah, it's a great feat indeed. As we come to the end of the session, I think this seminar would not have fulfilled its need unless we touch upon the fact, what is the message to investors from industry stalwarts like you all on, what they should be doing at this level of equity markets, because there is a lot of noise around the valuations, the concerns on the rich valuations which the markets are, and there is always a debate on whether should we continue, should we exit, should we put in fresh money. I would suggest that we would take inputs from all the panelists on their message to investors at this point in time and draw curtains on this session. Sandeep, would you like to start on this?
Thanks, Suresh. I think it's a consistent message over the years. Let the emotions not take over whenever the markets go up or markets go down. I think the biggest injustice we can do to ourselves, our family, and our portfolios is when we start investing, when we see the markets going up, or stop investing when the markets crash. I think there has to be a discipline, and the only way to achieve long-term goals is going to be the discipline. and emotions have to be controlled. So whether it's 60,000 or 30,000, if you have to continue your SIPs, you have to continue your SIPs, and you should not double your SIPs because the market has just 60,000.
Point taken, Sandeep. Vishal, would you want to step in with your 2 words?
Yeah, so adding to what Sandeep mentioned, I think the 2 things I keep telling myself as well as anyone I meet is that keep your focus on the goal, which is why did you get into the asset or equity in this case. And 2 is that keep a focus on the allocation. So to that extent, if you decide upfront that for the certain goal or objective you had, your allocation to different asset classes, and we all know, and there have been various studies that say that the bulk of your returns will really come out of the allocation rather than the individual product performance, etc. So if you're underinvested into equity, irrespective of the market, you need to build that up. If you're over-invested into equity, maybe because of valuation gains also, then you need to prune it. So that these 2 things put together, which is, what's your goal, and for that goal, what's the allocation, that can be a guiding principle to either step up or prune down the various allocations or, misallocations that may happen because of different asset classes moving over time. And like Sandeep mentioned, keep the emotions completely at bay, because behavioral challenges is what typically comes in and, eats away into the long-term potential of equities.
Thank you, Vishal. Thank you so much. Amit, what about you?
So, Suresh, I will echo what has been mentioned by Sandeep and Vishal. It is all about the portfolio allocation and your goal-based investing, which is very, very critical. I believe the disciplined approach is something which investors should look at all point of time. We have been propagating also on the debt side, because as an industry, we have been seeing a good allocation coming on the equity, but debt is something which we have been focusing very hard in terms of retailization, and also making sure that you have a different set of investors, and the homogeneity which we are facing in debt as a category has to go away. So it is all about taking each and every asset allocation, which is important, have a long-term approach, have a goal-based systematic investment thing is something which we have been focusing all along.
Thank you, Amit. Thank you. Mr. Rahman, can I invite you to give your closing remarks for the session?
My friend, in fact, Vishal, Amit, everybody has said, Sandeep, emotion away, goal-based investing. I would suggest that you please take your own decision based on your advisors, or whatever your advisor says, and that you consider your own risk appetite, and whatever the risk you want to take, you please take. I would always say that stay invested. Stay invested and never discontinue your SIP. So I would always recommend that stay invested.
Thank you, Mr. Rahman. So finally, as we draw close to this session, I would take this opportunity to thank on behalf of BCCI all the panelists for having taken their time out from their busy schedule to be part of this panel and share their thoughts for the participants. So thank you once again. Arnab, over to you.
Thank you, Mr. Kumar. Of course, we are really grateful to all of you for joining here with us. And after the last discussion about the investors, I just wanted to share that this year my father had been critically ill, and he had been hospitalized 6 times during the COVID periods. And obviously there was a crunch in fund, and the first thing that came into my mind that whatever happened, I'll take loan or whatever, but I should not miss my SIP. So that is the kind of thing that because until and unless you stick to your goal, that we have learned from so many years, that it is very difficult for to see that amount of money when the time is needed actually. So thanks to all of you. Thank you all of you again. I'm sure that we'll be able to do it in a physical format next year. Every time I'm keep going saying that. So with this, we'll end this session on capital market. I thank you all.
Thank you.
Thank you.
Thank you so much.
Thank you.
Thanks, everyone. Thank you, Sandeep. Thank you, Vishal.
Thank you.
रामू, 2 चाय दे यार।
अरे नहीं यार, एक चाय कॉफी।
इसको 30 डिग्रीज कर देते हैं।
अरे नहीं यार, 45 डिग्री सही है।
इस बार मनाली चलते हैं।
नहीं नहीं, गोवा।
सच है, we Indians disagree on everything, but we agree. SBI is the banker to every Indian.
अरे SBI कॉन्टेक्टलेस डेबिट कार्ड। सही भाई, आई एग्री।
SBI का वीडियो KYC सेविंग्स अकाउंट। सही है यार, फाइनली आई एग्री।
SBI से ट्रैक्टर लोन लिया, पाजी ये 100% सही किया।
SBI का होम लोन। जानू, दिस टाइम आई एग्री विद यू।
आप भी अग्री करेंगे। SBI is the banker to every Indian. बाकी बातों पर लगे रहो।
मुंबई मुंबई,
चेन्नई चेन्नई।
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Good afternoon and welcome back once again. We have very eminent speakers with us, Mr. Ramdev Agarwal, Chairman Motilal Oswal Financial Services, Mr. Dheeraj Relly, MD and CEO of HDFC Securities Limited. We are starting the experts roundtable session, the stock market story, learning from the big bull and scam 1992. I'm sure this would be a very, very interesting session, and as well as a very apt topic for discussion, since both these movies are big hit. And with this, I'll hand it over to our moderator, Mr. Siddhant Mehta, partner, Boston Consulting Group. Over to you, Mr. Mehta.
Thank you, Arnab. I think it's been really fascinating to hear the various industry leaders talk through the day, share their thoughts, and would call out a thanks to the Bengal Chamber for organizing this financial market conclave. A very good afternoon, good evening to everyone who's watching, and also a welcome to our esteemed panel members. Welcome Dheeraj, welcome Ramdev. As Arnab said, I think we have a very interesting topic. The stock market story. I think the learning from Big Bull and Scam 1992. To get going, I think the Indian stock market has had a significant evolution over the last few decades, and in the last 18 to 24 months itself, it has had a very, very interesting story. While all of us have and are still dealing with the pandemic, I think the market has seen a tremendous journey in this period. Some interesting points which indicate and highlight some of this journey. One of the very interesting things that I noticed was the stock market actually grew from, we've reached the $3 trillion market cap recently, right? And the $500 billion market cap that got added from 2.5 to 3 trillion was actually added in about just over 150 days, which is just about 5 months. What is interesting is the previous $500 billion, that took more than 1,200 days. That's about 7 to 8 times, from 2 to 2.5 trillion versus 2.5 to 3 trillion. I mean, this gives great joy, but also I think it raises a bit of caution, I think, that we have all been sensing, right? I think while there is, that happening on one extreme, there's also a dramatic influx of retail investors that we have been seeing, in the stock markets. The last year saw about, 1.4 crores customers, investors get added to the stock market. And if we look at the numbers in the last quarter of, or the first quarter of this year, that pace has only accelerated, right? And I think in the larger scheme of things, I think this is a very pivotal moment for the entire market, because at the highest level, if we look at just the share of financial savings that get driven from equity, it's still fairly low as we compare to some of the other markets, right? So needless to say, I think very interesting times for the financial markets, and look forward to getting perspectives from both you, Dheeraj, and Ramdev on some of these topics. Maybe to kickstart the discussion, Dheeraj, I'll invite you on the first question, right? As I was saying, I think one of the major trends that we have seen is just this significant influx of retail investors in the last 18 months. 14 million investors have gotten added. The number is only increasing. The pace is only increasing. In your view, how is this shaping, the stock market? What impact is it going to have? And how do you see this trend to play out?
The question is for me, Siddhant?
Yes, Dheeraj.
Okay. Thank you, Siddhant. I think we have had a fabulous influx of the customers in the broking industry, and we are all very happy with that. We all were yearning and waiting for the same for last 2 decades. We've been working relentlessly in the equity space and trying to entice the customers with the potential of that equity offers. If you look at the 5 years, 10 years, 20 year, 30 year numbers, you will see that 10 year and above, Sensex has given continuously double-digit returns and outperformed all asset classes. However, it took long for the customers, investors to appreciate the potential. I think the pandemic paved the way for us. The only fallout, the positive fallout of the pandemic is that we have seen people had time, people had resources, people had, equipments, mobile phones, gadgets available with them to participate in the market, and they got the significant correction in the March 2020. So that actually triggered a big movement for the customers. And I would like to thank SEBI also for taking the positive move by allowing the digital onboarding of the customer. That changed the landscape for the acquisition and reduced the cost of acquisition. So that's from the influx of the customers. But what it brings to the table is very different thing. It changes the balance and the equation in the market. The markets were earlier dominated by the institutional investors, whether it is FPIs or domestic institutional investors. But now the equation has changed. Retail plays incrementally a very, very important role. This also gives an opportunity for corporates to access to the growth capital also. Along with the investors, what we've seen, the boom in the IPOs as well, and seen that many customers are using the IPO as a route to invest into the stock market. So it has changed the dynamic and the balance of the market, and it has provided the liquidity to the market also. I am hoping and looking forward for that this kind of momentum to continue. As you have rightly articulated, the penetrations of the equity in India is still at abysmally low, just about 4% or so. If you look at the active clients, it will be less than 3%. So we have a long way to go to catch up with China, where this penetration level is 13%. Forget about US and other developed economies where this is as high as 45 to 50%. So that's where we are, Siddhant, in the addition of retail clients.
Completely agree, Dheeraj. And as you said, it's a very, very pivotal sort of journey and moment for us. Ramdev, would be quite helpful to get your views on this topic as well. And I think not only what has sort of driven this influx, but how do we also continue this momentum and not make it a story of the last couple of years and all the reasons that Dheeraj described, because as all of us know, I think the journey for us is very long, right? There's a long way to go. So request your thoughts on that.
Yeah, I think this is one of the most important. If you can just discuss in half an hour just about this subject, I think this is hugely important. And for some reason, the retail investors were held back for last say 25-30 years. Once the digital and SEBI came in 93-94, after that this KYC regulations came, and then there was no breakthrough. I mean, everybody tried, SEBI itself tried, we also tried, everybody tried, but I mean, it actually started becoming worse actually, and people were actually held off while they're coming with the money. See, the KYC is required for when you're lending money, because you're lending, you're taking risk on him. But when he's bringing his money into the market, actually you should come with without any asking for any questions. You are coming with the money. You have a bank account, period. Rest all others will take care. But no, the KYC were more stringent for the guys who are wanting to invest, not borrow. The borrowers' bank accounts are 800 million. Savings bank account, and I don't know how many millions are there in HDFC Bank, Dheeraj?
We have about 6 million saving bank customers in HDFC Bank.
6 million or 60 million? How
60
many?
million, sorry, 60 million.
That's what I was saying.
Right.
60 million. And SBI would be what? About 250 million? SBI?
Yes, SBI, yes.
About 250. We have in the entire stock market, small, big, 40 million customers after expansion of doubling. So till 12 months back, it was just about 20 million. So this looks to be very simple, but it is a revolution, I'm telling you. And the thing required to be done is that you give more push to a simplification of KYC, then come on the way of it. Don't get scared that there's a scam, there is a stock market, and then you stop the influx of the retail and all, because some people will burn their hand at the end of it. But that doesn't mean you stop. So I think Dheeraj dwelled upon one thing, that it brings growth capital. The function of the market are two. One, to allow the people to raise capital, companies to raise capital, and then provide secondary market liquidity for the people who have invested, so that secondary investors can come and primary investors can be relieved. So that liquidity to the equity capital is a major function. So the second function is happening very well. First function was completely dead. It is just about revived 3 months back. This has power to actually change the Indian GDP growth rate. The growth rate of the country can be changed, because there are ample entrepreneurs, but entrepreneurs are not getting the money because they were in the hands of FIIs. They were in the hands of DIIs. Those guys, they are not going to give 1,000 rupees, 2,000 rupees to the investors. They are happy getting 5%, 10% at some crazy price. So now this retail movement is going to bring, first, it will give a good valuation to the market. Second, it will actually truly provide high quality liquidity, distributed ownership, high quality liquidity. And if the investor population goes from 40 million to say 250 million, 200 million, see, it is 5x I'm talking about. If it takes 5 years, I think you see the market structure completely changing. Completely changing. I mean, it will become more speculative, very stable. I mean, the importance of institutions will get reduced. So much more fairer, what you call discovery of the price, and a lot of small companies where institutions are not interested. Below that 250, below 4,000-5,000 crores, who is interested? Only retail is interested. So who brings the small tree when it is 200 crores, 300 crores to $1 billion? When the institutions get interested, it is all retail. So retail will play a very pivotal role, and this is a revolution I'm telling. In my 40 years of career, nothing like this has ever happened. This is the biggest game right now in town.
And Ramdev, the importance of retail, you emphasize it really, really well, right? On the multiple cascading benefits it has. But if I had to ask, right, if there was one wish or one area that the industry must act on, you both spoke about multiple things which has aided the growth, right? SEBI introduced or enabled the digital onboarding process, paperless, streamlining all of that. But what would be that one additional area which ensures that this momentum continues and we continue to get an influx of retail investors? As you said, I mean, there are millions and millions who have access to financial services, who have bank accounts, but are probably not participating.
Yeah, so first thing is, don't come on the way of this revolution. Don't get scared when it becomes too big. Because the pace of the influx, it's like that Nasik Mela and all, that Kumbh Mela. A lot of people come in very short while. So it will create chaos. So you have to manage the crowd. The policing has to be very good. So a lot of crooks from the corporate side will try to encash on that. So SEBI's job is to see that the bad apples don't come into the market, because they are the guys who finally approve. So that is one of the very important things, because in the stock market, you can't figure out those retail, unfortunately, doesn't have power to decipher good and bad. And one of the things is that bad guys, they shine more than the good guys. So it is very difficult to figure out what is good and what is bad. And in the stock market, only good things compound, not the bad thing. So bad thing will give, if your proportion, see, on 100, either 5 or 10 bad apples, it's fine. That's part of life. But if by chance in 100, you have 90 bad apples and 10 good apples, then you have a problem. Because then it will have a very bad experience. And once retail goes back, then they may never come back. I mean, they may take a lot of time to come back. But I think not stopping them from coming and regulating the entire street, it's like a mela, it's like a festival. When this festival is happening, it is a job of the SEBI and whatever regulatory authority to see that nobody plays foul.
Got it. I think just, continuing that discussion of, retail investors participating in the financial markets. Dheeraj, I mean, in the 90s, participating in equity largely meant, participating directly via the stock market, right? Direct equity participation. There were a bunch of things, good and bad, as the title of our session says, right? Which were driving some of that. Over the last decade, mutual funds have also sort of grown in quite a meaningful way. And a lot of investors today, who are looking to participate in equity, there is this dilemma of saying, should we participate directly or should we go via the mutual funds to participate in the equity markets, right? What is your perspective, Dheeraj, on, how should investors think about, where do you think the wave will move in this journey?
Siddhant, the mutual fund industry has played a very critical role to increase the penetration of equity in India. I think they have done a phenomenal job, and we've seen a significant growth in last 5-7 years only. Okay, if you look at the 25-year journey, first 20 years, it was more of a concept selling, and last 5-7 years, we've seen the growth in the AUMs. And still the AUM, equity AUM of mutual fund is still just about less than 10% of the banking deposits only. It's just about 14 lakh crore and banking deposits are 155 lakh crore. So to that extent, we have long way to go to increase the equity participation. Coming back to your question, which route is a better route? I think if customers have understanding and they have
learned about the markets, then they can use the direct equity route. Otherwise, for the first time investors, it is important that they should take the mutual fund route and get more diversified portfolio. Though in the direct equity also nowadays the diversified options are available through the curated baskets, and ETFs route is also available with the investors. So it's purely up to the investors and the level of understanding and skill set they have. Those who have some experience in the market, they can venture into the equities directly. There also a word of caution to the retail investors, particularly. They should learn to differentiate between the quality businesses, quality companies versus the all other listed companies also. So if customers are entering in the market for the first time, they should focus on the market leaders only, top companies also in their respective sectors, and large cap probably will be a better choice for them.
Understood. Ramdev, your thoughts on this?
Yeah, I think mutual funds are, we have the best regulation, best taxation policy for mutual funds probably in the world. So this is everybody, stock market is at one level it is simple, but it's very difficult to really execute successfully. So the best thing is that, like, if you don't know driving, you hire a driver or a cab driver, you hire a cab. So mutual funds are nothing but a safe cab for the people who want to just invest. People are busy in their own stuff. They are farmers, they are engineers, they are doctors. They're busy in their own profession. So, investment management is a full-time job. So who can do a good job for a 0.5%, 1%? And if you're buying ETF, you're buying for 5, 10 paisa, 15 paisa. I think it is one of the cheapest mode of hiring a very good expert to take care of your money. So what is important in the stock market is to first start getting the market return. And market return, you get it the moment you invest in mutual funds. So if markets have done 15% compound in the last 40 years, 99% of the people don't get 15%. So let me get my retail crowd, brothers, into the fold of getting at least 15%. Their money should not be rotting into the bank or in their own sacks, which is going to give them 4-5%. So how do I take them from 5% to 15%? And that is done very easily with the mutual fund, ETFs, index funds. That is being done. Now, after that, once he learns to pick his own stocks, of course, he can dabble in the stocks. And then the big guys can definitely manage their own portfolio, and they have their own information system, analytical system, and try to earn higher than index. But I think the discussion about the retail is clearly through intervention of mutual fund and index fund, and people should learn. First, they should allocate. What is important is, if you have a crore to start, first you must allocate to equities through mutual funds, I would say. And then you want to learn a little bit of ropes of picking a stock, then 5%, 10% you try, you'll definitely lose money initially. There is a tuition fee to learn. So pay as small a tuition fee as possible. I have paid enough of it because that time mutual fund was not there in our time. So there was no support. You have to do it yourself and get wiped out. Most of the guys, they get wiped out. So don't get wiped out. There's no second day if you are wiped out. So you must take, definitely the first timers should definitely take help of mutual fund industry. And as they become smart, of course, they can themselves kind of take care of their portfolio. So huge role of all these guys who are coming in today. They are not coming directly to the mutual fund, unfortunately. They're entering through the direct stocks or direct stocks basically. So what will happen? They will have a bad experience. Let me tell you. They will have, right now markets are riding. They will see some short-term gains, and a lot of people are entering through a speculative route. They're not entering through investment route. So then in the second coming, they'll come to the SIPs and mutual funds. So it will be a gap of 2 to 3 years. The guys who lose out here, second term, they'll come to the SIP. So this churn will happen. I'm quite sure about it. But it doesn't matter how they enter. They must enter. That is what my sense is. It is going to change the profile of this country.
I'm sure, Ramdev, I think your advice that you just gave is going to be very beneficial for many of the, early investors or the recent entrants into the stock market. And the point that you made, the contribution and the importance of mutual fund. in deepening and establishing a sustainable stock market participation from retail. It's very, very critical. I think just continuing the theme of retail, right? Another important trend that has played out and has contributed quite meaningfully is this whole wave of fintechs, right? And they have been around for a while, but of late, a lot of them have become larger. A lot of them are sort of gaining scale. From your vantage point, how do we see these fintechs? Are these competitors? Are these enablers? Are they driving the industry agenda? Maybe Dheeraj, first with you, and then Ramdev, get your thoughts on this as well.
Fintechs in India have done a really great job. I think they have looked at niche areas, particularly areas where there are transaction-oriented business, where they don't need much capital. I think that these are the areas they have targeted, and they have targeted these areas very well. What they bring on the table is that they bring in passion and they focus on particular problem and solve that problem with technology and make it more scalable. So to that extent, I am a big fan of fintechs. And what we see fintechs, they are in broking industry per se, they are expanding the market, which is the most important area for all of us. The incumbent players have been working on expanding the market, but with the advent of fintechs, we have seen that the reach has increased, the products are easy, the transaction costs have reduced significantly for the customers. So it's added a big value to the industry as a whole. We don't see fintechs as a threat or a competition. We see fintech as partners, and many fintechs are giving a particular solution that is becoming an enabler. So we work with fintechs very, very closely to solve specific niche problems that may help us to serve our customers better. So that's the way we are looking at fintechs. We've been also investing in some of these fintechs also to ride on their growth story also. So I think fintechs are here to stay, and we will collaborate with them.
Ramdev, your thoughts on this?
Yeah, see, fintech, the way I understand, is that it has the power to it has the mass customization capability. It can actually reach, the good service. See, big guys can get everything. All the guys, all the bankers, they'll call, whenever they want, 2 o'clock in the night, they'll come and serve them. But what about the small guy? Only internet can do it. Only the fintechs can do it. So it is actually most democratic force. And because of the power of platform, it doesn't matter how small a guy you are. And the small guy with her 10,000 rupees, he gets as good a service or probably more enlightened service than what even $1 million guy is doing. Because ultimately a relationship manager has limited knowledge about the products. But with the fintech, they can really reach the best of the knowledge to the smallest possible guy. So fintech has a huge role to play. They're at early stage right now. They've done a damn good job on the broking side. The reach has been fantastic. We onboard customers in less than 10 minutes. So it is not possible with any kind of even least possible human intervention. You cannot do in 10 minutes. It has to be only digital. And the scalability. You don't need 500 brokers. 10, 15 brokers are good enough to take care of this entire nation. So I think fintech had its own, but at the same time, as you go to managing money, how much role fintech has its own limitations, but they're evolving continuously. Most of the now investment management is going towards quant management, and a whole lot of rule-based investing is coming. Yeah. And that is where the fintechs are going to play a huge role. And the role of so I think it will be man plus machine kind of a situation and where earlier it was 100% man, now maybe it is 50% man, 50% digital. And as we go along, I think the role of digital in every aspect of it, even in analytical forces or buying, selling, it will keep increasing the quotient of the digital, and that's what we'll call finally fintech. So I think the role of fintech will increase in every aspect of financial management.
And Ramdev, I think you summed it up really well. And I think internally, I like to call it the Iron Man approach, right? So there would be human, but there is also a machine associated with you,
Yeah,
right?
yeah.
Which is going to be the way forward. I don't think there is an answer of being just digital or just human. I think
Yeah,
in
Siddharth,
all facets of businesses.
yeah, Siddharth, what happens is the markets are continuously evolving machine. So market beats the machine at some point of time. Machines are extrapolating kind of a thing. Somewhere there has to be some judgmental thing. Like GFC is completely problem of machine. Machine went haywire, and even the ITNs from in Wall Street, they forgot that there is some common sense required. Giving loan to anybody, any quantity. So that happened because machine said so. So I think somewhere in the stock market, also you have to judge the difference between price and value, and that can be not done so well on a dynamic basis by the machine. There has to be human intervention.
And as we come closer to the end of our session, but I wanted to shift gears, and given this theme of scam in this series got really famous, I think there was this quote which probably caught attention of everyone, right? Which was risk hai to ishq hai, right? And on that theme, I think there has been this divergence between how the financial markets have been performing, and coincidentally this series came in about the same time, right, when pandemic hit us. The markets have rallied, and the economic situation in the country, the economic health of the country has been in a certain divergent direction. Dheeraj, what is your view? What explains this? Is this a bubble? How does a common investor understand the situation?
I think this is the single most cliche question that I get everywhere, that why there is a dichotomy between the economy, GDP performance and the market performance, why they are moving in different directions. I think if there is a need to understand that markets may not have a direct correlation with the performance of the economy. Why? Because there are many sectors that have dependence on global revenues, like pharma or even IT to large extent. So they are driven by the global growth, and there can be a non-Indian reason also why they are doing so well. Also, market always discount the future expectations, and they are discounting already the good times ahead of few quarters. It's only riding on the expectation that we will have a 20 to 22% earning growth in the next 3 to 4 fiscals. So that's something, that's the reason why we are seeing a market going in one direction and the economy going in the other direction. Having said that, I think there are green shoots in the economy also. We are seeing that tax collections are improving, GST collections are improving, and last quarter GDP growth was also almost in double digits. So that way we are seeing some green shoots also. Hopefully we are at the end of the pandemic, and we will probably grow from here onwards. Market has a habit of discounting the future expectations well in advance. That's where the market is probably ahead of the curve. And this is what happens when there is a bullish phase. And this also happens when there is a bearish phase also. When markets are able to see the problems coming ahead, and they are able to, they are more bearish than the economy sometimes. So there is no direct correlation in economy and the markets.
Ramdev, maybe quick 60 seconds from you as well on this topic.
Yeah, so in the short run, there is there can be no correlation between markets and the economy. But in the long run, it's a weighing machine. Like as it is said, in the short run, it's a what is that? It's an opinion. In the short run, it's an opinion, but in the long run, it's a weighing machine. So if economy doesn't perform for a very long time, eventually it will collapse. So, but then the way the journey starts, at economy level, the bullishness about the economy, that economy is now opening up. Who knows in what form? China is slightly out of action. Global liquidity is massive. Cost of liquidity is massive. Collapse of fixed income. And the startups are happening. FI flows are there. Your retail flows are there. So all kinds of things are happening. So you can make your own story. But whether the story turns out to be right or not, that only time will tell. But today I have to value it. Say like a digital company is saying that today I'm delivering, 40 million, 400 million packets. In next 5 years, I will deliver a billion packets. Okay, now this is a story. So the issue is that markets are believing it today. That's in the mood of belief. Markets are in a greedy mode. There is a greedy mode. There is risk mode. Right now, it's a kind of a little greedy, and hence they're riding on the stories. Whatever is the hopeful stories of future. Now, whether actually delivers or not, that's the key issue, and then it will converge. I mean, you can fool us around once, twice, thrice, and then finally, if you don't deliver, the stocks will collapse. So I think yes, there is right now liquidity is prevailing over the fundamentals, but at some point of time, the fundamentals will meet. The story right now, it's a story, but numbers have to match. But that may have maybe 1 or 2 years, 3 years time.
Understood. Very helpful, Ramdev and Dheeraj. I think we have just come to an end to our session as well. I would take this opportunity to thank both of you for your time and for your thoughts. This was extremely insightful and thoughtful discussion. And thanks to everyone who joined us. Arnab, back to you.
Thank you, Mr. Mehta. And we are so grateful to Mr. Ramdev Agarwal, Chairman, Motilal Oswal Financial Services, and also to Mr. Dheeraj Delhi, MD and CEO of HDFC Securities Limited. With this, we end this session on the stock market story, learning from the big bull and scam 1992. Stay with us. We'll be coming back exactly at 4 o'clock for the insurance sector. Thank you. Thank you.
Thanks. Thanks.
Thank you.
Thank you.
रामू 2 चाय दे यार।
अरे नहीं यार, एक चाय कॉफी।
इसको 30 डिग्रीज कर देते हैं।
अरे नहीं यार, 45 डिग्री सही है।
इस बार मनाली चलते हैं।
नहीं नहीं, गोवा।
सच है, we Indians disagree on everything, but we agree. SBI is the banker to every Indian.
अरे SBI कॉन्टेक्टलेस डेबिट कार्ड। सही भाई, आई एग्री।
SBI का वीडियो KYC सेविंग्स अकाउंट। सही है यार, फाइनली आई एग्री।
SBI से ट्रैक्टर लोन लिया, पाजी ये 100% सही किया।
SBI का होम लोन। जानू, दिस टाइम आई एग्री विद यू।
आप भी एग्री करेंगे। SBI is the banker to every Indian. बाकी बातों पर लगे रहो।
मुंबई मुंबई
चेन्नई चेन्नई।
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Good afternoon. Welcome back again at the Financial Market E-Conclave. We have a very interesting session ahead with us. Experts Roundtable on Indian insurance industry riding through the waves. The session moderator would be Mr. Parthanil Ghosh, President, Motor Business, HDFC Argo General Insurance Company Limited, and member of BCCI Banking and Finance Committee. We have Mr. Ghosh, Joint President, Kotak Life Insurance Company Limited, Mr. Ravi Vishwanath, President, A&H Business, HDFC Argo General Insurance Company Limited, Mr. Alok Agarwal, Executive Director, ICICI Lombard General Insurance Company Limited, and Mr. Vidya Prakash, Senior VP, High Opportunity Market, Tata AIG General Insurance Company Limited. With this, I'll hand it over to Mr. Ghosh to take it forward. Thank you, sir.
Thank you, Arnab, and welcome, friends, Alok, Ravi, and Alok, Ravi, Shubhashish, Vidya, thank you for participating in this session. Of course, we were going through the waves, or we are going through the waves. We do not know whichever reports we read, whether we are in the third wave. Somewhere they are saying the third wave has started. Someone is saying, no, it is not happening. But good thing is that the vaccinations have crossed 80 crores. But as we speak, we know that the last 2 years or 18 months, we have got almost 3.4 crores people got infected, 4.5 lakh very, very unfortunate deaths. And while we were going through the entire statistics, I was seeing that almost 23.65 lakh claims were paid between the non-life companies and the SAHI companies, totaling about 30,000 crores till middle of August. Even for the last financial year, that is a report I have, Subhashish, and you can say that better. almost 1700 crores of claims were paid by the life insurance industries on a net basis. So, this is a situation where of course, the growth rate of both the non-life insurance industry and the life insurance industry took a beating last year, 5.2% for general insurance and around 7.5% for the life insurance. Though the SAHI companies, the standalone health insurance companies, did particularly well at 11%. And this year, the standalone health insurance companies in the first 5 months have been really doing well, 41% growth. And that's a fantastic growth. The demand is back for health products. I think that's a great positive if we can talk about for the COVID. On this backdrop, if we start the discussion, and Alok, if we start the discussion with you, and then all the panel members can contribute on that particular point, that how actually, what helped your organization to ride through the 2 waves of COVID?
So, the COVID struck last year in the month of March suddenly. Many of us did not expect, and the way it struck many of us, it left us very surprised. So initially, the reaction was how to work from home and how digital will take it up, how we will be able to issue policy, how we will be able to book the policies, and all these things were the main concern. But as time passed by and we realized that this is the truth for the next few months, the one most important thing, the reason why we exist is to pay claims. So we found ways of settling the claims on digital basis at the very fast pace. Insurance companies in India, somehow there is some bit of trust deficit with the customers. In spite of the fact that general insurance companies, I would say, pay very high amount of claims, as you mentioned in the prelude to this this program. We still, if you ask a common man, he's very skeptical whether the insurance company will actually pay the claim or not. So we wanted that the moment of truth, when the moment of truth is coming, we should actually be paying the claims, and we should be actually delivering it faster than we would have done had the pandemic not struck. One thing which helped us is, in general, we were slightly more digitized than many of our competitors. And therefore it helped us better than others, but that is no excuse here. You have to be, we are not competing only with the insurance companies. We were at that time competing with the general ecosystem, and the ecosystem has Amazons of the world, they have Flipkarts of the world, and who are delivering at the blink of an eye. So the customers are the same, whether they are buying through Amazon or taking an insurance claim. So their expectation was far, far different from what it used to be when they used to compare it with some legacy companies. So therefore, the claim was one area that we focused on, and we had to change our systems. We had to take digital documents. We had to take some alternate documents. We had to give some trust to the customer and say that we will take a leap of faith and pay these claims if X number of X percentage of documents have been given, and go ahead. So this is how basically first wave, as it struck, we said that we will first make ourselves comfortable to work from home. That itself, I give the hardware to everybody, make everybody comfortable with the technology. And second is that address the claim, and then all the other things which were around that were slowly put into place. So that would be in a nutshell how we reacted to the multiple waves of the claim.
And Subhashish, if I come to you, how has the life insurance industry approached that? Because your problems were slightly different. Because in case of health insurance companies or the people dealing with health only, their problem is large number of transactions and all, but you are dealing with a different kind of an issue. So how you responded?
Okay, so there are two parts to the story. One is, I would look at it, okay, not two, I would say three parts to the story. First, of course, we have to look at at the point of view of the consumer, because he or she is the person who's getting affected. Now, there are two types of consumer. The consumer who's continuing with the policy and is concerned that the documents are in order or not. Second is, of course, nominees, unfortunate nominees of those consumers for whom claim has to be paid. Life insurance, the claim is when the person is not there, most of the cases. This was not a critical illness, this was this thing. And the third is the employees themselves. We mustn't forget the employees, because who is going to service the customer if the employee is also scared to come to office, also scared to work. So the first thing that we did actually was to see how much digitization, or how much, forget digitization, how much laptops we can reach out to our employees in such short periods of time. How much broadband, how much work from home facilities we can give to the employees. Because obviously we are not prepared for working from home. Digitization is easy, but everybody was coming to office and working. So that was the thing. So the claim had to go on, smoothly. So the first thing was to try and see if insurance can be put as an essential service. That was the first and most important thing, because nobody was sure whether they can even come to office or not. So when that happened, and of course the industry put the matter aside to the concerned government departments, that then we had to tackle the problem of local area not allowing you to do that. So even you got the sticker on your car or the motorcycle, the police would not allow you to go and service the client. And surprisingly, we had found, not surprisingly, logically also maybe, a lot of clients wanted to come to the office because quickly they want to say, is my nomination right or not? Have I paid my this thing right or not? Whatever, that my EMIs, my premiums correctly or not? So very quickly we had to understand all the reasons for which a customer visits the office. We had bits and pieces in place. So we put everything in place so that the customer doesn't have to come to our office. But at the same time, we did have to open for half a day for people who did want to come to office. See, ultimately we have to exist for the customer. If the customer says, I still want to come by the physical channel, I want to have the comfort of talking to somebody rather than sending some scanned copies across. I cannot say, sorry, I'll be in my home, I'll be working from my home. So employee, colleagues, that is on our side, and the customer on the other side who wants to make sure the documents are right. That was very important. And also provide the person with an online mechanism. Then how to get the information out, that because they're not used to servicing themselves. So you make videos that you do this, you do that, and then things are you don't have to come to office for that. And finally, the unfortunate thing about the claims started happening. First wave was in a sense, actually we got time between the two waves, because the first wave that happened helped us in putting our house in order. When the second wave hit, it was devastating. And the industry, in two ways, we've paid claims. I can tell you about my own company. In the 5.5 months, we have paid value of claim equal to what we paid in the entire last year. So two things have to happen. And the claims in the first quarter, Q1 of this year, went up 5x. So the ability, but see, we have to pay the claims on time. We have to be fast about it. But you can't have 5x employees. And that too in the middle of the lockdown. This time, lockdown also was quite severe. So we had manpower challenges. We had software challenges. Clients also have problems in getting the death certificate and giving it to us on time. So we reached out a lot. We reached out a lot to people that if we are having a problem, maybe we will send our investigator to pick up the documents from the hospital, because in life insurance, you do investigation, in general insurance also, and health also, you do investigations to see what has happened. And we tried to see that all COVID deaths were paid in 24 hours. And industry did it. And regulators also put a lot of work in that. So it has been very hectic. But I do think that the industry probably has risen to the challenge and delivered what the customer wanted at the most critical points of time. Also to the colleagues who put this thing together.
No, thank you, Subhashish. Of course, the second wave has been quite devastating. And you rightly said 5x. In the general insurance and the health insurance industry, the first quarter payment of claims was more than that of the entire period of last year. So it has been quite devastating. Vidya, if we can come to you. So how your organization passed through these two phases?
So to my mind, the experience and the feel on the ground of first and second phase in terms of what was actually happening on the ground, in terms of challenges of lockdown, administrative issues, moving from one location to another location. So it has been said by Mr. Alok and Subhashish, how we were different in addition to what they have said. So definitely the biggest advantage we as an organization had was in the name of Tata, to be more precise, where the trust itself was so high, and the resilience what we had in the system, because as an organization, if you see, we are expanding in retail, but claims are coming from far-flung areas, right? So challenges were, we were expanding, distribution were getting created, and probably we have created the largest distribution network during this pandemic times itself. Digitization was also happening. Adaptation of technology was getting faster. So how to train, the producers, the channel partners to handle the claim, to train our employee. So all these have been very, very hectic in terms of execution on the ground. And that is where I say, probably the name, the Tata, has helped us a lot, with the resilience what we had in the system to accommodate ourselves and, to handle this first wave and second wave. In addition to what, both of the senior member on this platform has said.
No, that
is an ongoing process. It's a journey, and it has been a big transitory phase for, entire GI industry, to my mind. We can see how insurance being a conversational sales is moving towards not a sales, but to be bought by the customer. The transition we are seeing very clearly happening. Are we there? Yes, we are nearing that. Immediate future, we can see that.
No, that is interesting, Vidya, and what rightly you have said, that you have moved from a push product to a pull product as an insurance, as a category, and people really realizing the importance of insurance. And of course, this pandemic, if one positive thing that can come out of this pandemic, there are a few, and we will discuss a few of them, but definitely this is one where people understanding the importance of insurance. Thank you. So coming to you, Ravi, so everyone spoke about what Alok or Shubhashish or Vidya spoke about, digitization, taking care of the employees. I think you actually had a different kind of a challenge within the pandemic. You had your existing set of customers. You are also involved into a very, very complex migration process because of the merger of Apollo Munich. This entire organization with a huge number of customers, channel partners, and employees. So how you took this entire organization through these two waves, and what are your learnings of it?
Yeah, so it was obviously a very complicated integration. So we were integrating 8,000 employees, 140,000 advisors, multiple systems, people working in different cities, and so on and so forth. So an integration of that kind anyway is complicated. And it was further complicated because we now had to do this whole thing remotely, while also growing sales and making sure that we're serving our customers during COVID. And I think that a few things that kind of helped us, one was that is the investments that as a company we'd made earlier in digitalization. The processes that we had, which were robust and kind of stood up to the test that we put it through. And I don't think you can have a better stress test than what we put the systems through. And luckily for us, and thanks to our colleagues, the system delivered as it was designed to do. I think that was great. But also what was very important and interesting, I think, is the entire people angle and how people try to come together to help each other and support each other. Because during COVID, for example, while we're doing the transition and systems are getting integrated, there are all these claims happening. And while the claims are happening, there are people in the claims team. We lost some employees in the claims team. We had many of our colleagues whose parents were sick or who lost their lives. And through all that, to make sure that we put the customer first and we're able to serve the customer, I think really helped build the resilience of the company. And really hats off to the team for going through that process and delivering an integration in what to me is in a record time, while growing the business and serving the customer. So doing all those things simultaneously was really a Herculean task. But really, ultimately, I think it comes down to the investments that the company continually made in technology, digitization processes, as well as the quality of the people and the ability and willingness to work together. for the common good.
No, that's so. As I see that, apart from the resilience of the team coming together, one common theme that is coming out from all of you is the kind of digitalization or the technology progress or the investments in technology that has happened in all the companies. So taking a cue, and we were also reading various kinds of reports that the pace of digitalization most probably has advanced 5 years because of this pandemic, and that is something a plus. But along with it, along with this digitalization, what has actually happened, the expectation of customers from the insurance companies to the digital route has also may have changed. So their expectation is not the earlier expectation that I pay a premium by a website or by a mobile, and they will get the policy at some point of time. So this entire customer experience expectation has most probably undergone a change. So how do you see to it? Means how do you, Subhashish, and I start with you, in the life insurance industry, how you are approaching this issue of the changing of customer expectation from the digital point of view, technology point of view?
In fact, I was actually just attending a program on innovation, which is currently happening on this topic only, because probably we realize we really don't know. I'm very honest with you. I don't think we know enough. We know enough, we don't know enough. So probably we have to do more than what the customer expects. See, one is that customer expects, but customer also does not know what to expect. This is, see, what has happened from the life insurance industry perspective. I can tell you, no one has ever faced this in his life before, ever. And no one has even heard about it. Now we are reading about Spanish flu, but no one ever knew it. So to be future ready, we have to go beyond what the customer is currently expecting and do what he may expect in future, or give him something. So we are actually engaging with international consultants, and one by one we are having, I think I must have handed at least half a dozen meetings on this topic only, to see what is happening in other parts of the world, so that we fast forward instead of thinking through. At least let us quickly fast forward our learnings and ask the customer. See, there are two parts. Life insurance, there are two parts. There are in other parts also. Generally, there's a transaction and there is advice. Life insurance is heavily on advice. Because I am asking a person to pay a premium for 20, 30 years. He or she shouldn't change the policy after next year, which is there in the other forms of insurance. So transaction can be online. Advice is a bit more difficult and far more complicated. See, I'm again looking at today's situation. What will happen 5 years later, I don't know. But someone who's used to having someone come and to you, explain to you, or you're going to the bank RM is coming to you, or agent is coming to you, explaining to him 3, 4, 5, 6 times, then finally you're satisfied that you're taking a policy. I may still experiment online. I may still check out rates online. But finally, when I'm cutting out a check, at least as of now, I still want to see face to face. Unless I buy pure term, which is again very close to a GI kind of a product. But when I'm expecting a return, there is a savings element attached to it, I would want an advice. It's very unlikely I'm going to cut out a check. So there, how to give that advice, sitting in the safety of the home, the complexity of our language. Vernacular is a big thing in our country. The technical terms. So that I would say we are having a huge, not huge, we are looking at building blocks and trying to attack it one point at a time. Journey of 1,000 steps starts with a journey of 1,000 miles starts with a single step. So we are taking step by step approach and building blocks and trying to continuously change along with that. Everything. The website, we are making it a little bit more interactive, lot more interactive actually. Our chatbot, we are making it more intelligent. So incremental changes we are continuously doing so that we are all on that journey.
No, in fact, Subhashish, I think you are what you are saying, that you are at the building, or you are at absolutely the design stage on an exploration to find out what is happening. And actually globally also, I was reading a report of one of the big fours, and they are saying that one of the major topic of insurance today is the technology part, the digitalization, but technology, what will move to cloud, what will move to something else, how your data structure will be, and how you are going to manage this entire piece. And of course, the Uberization of insurance or Amazonization of insurance, how it is to be. That is very, very interesting. So coming to Vidya, to you, I see that you absolutely operate on the emerging markets. So the markets which normally people have started talking about it, the tier 2, tier 3 and 4 towns. How do you see the customer expectation changing during these times when everything was under lockdown? People are going for more digitalization. You also mentioned that. So how their expectation, do you see a shift of expectation from those customers?
So I think we are into an era of unprecedented digitization. And the stage of cycle, particularly if I have to talk from India perspective, we are at the best stage. And I will tell you why. India as a country, among all the emerging nations, we don't have a legacy of infrastructure, at least into the interiors of India. So cost of adopting technology, and with literate population we have with 70% plus of literacy rate in these markets, and look at the smartphones today each and every individual have in their pockets. Now today's smartphone is not a mobile, it's a supercomputer of the past, right? So they are really carrying supercomputer in their pockets. Internet at the low cost, bandwidth, what they have. Our infrastructure legacy is zero. The entire ecosystem we have to look at, right? Insurance penetration in India, probably one of the lowest in GI among the countries which we can compare with. Insurance density, again, one of the lowest. And I'm just putting the pointers. So if we connect all these pointers, we get to understand where we actually stand and how the explosion we are going to see in the general insurance space in days to come. Earlier, general insurance, or insurance product was actually, mere ko kuch nahi hoga, that was the attitude. But now due to pandemic, and not only pandemic, I will say, because of cyclones also, Bay of Bengal used to get cyclones, we knew. And this example I keep giving, but Arabian Sea, which never used to see cyclones, now look at the frequency of cyclones even in Arabian Sea. So what does all this lead to at the end of the day? Motor insurance is mandatory. SME insurance was one of the least penetrated market. Health insurance was not there. So what has all this led to? It has led to today people have started asking for it. They have realized that the production which they need is why they need. This is the changing customer awareness and behavior which we can see on the ground. Ecosystem has evolved. Again, pandemic has, accelerated the entire pace. I can say, and I shall say, that we have seen decadal change in 10 months, actually. It has been so fast. Is it going to stop here? To my mind, answer is no. Artificial intelligence, chatbot probably has become the new normal today. Now, what we are going to see in days to come is much beyond machine learning now. It will be deep learning. Now, yesteryear, social media or the platform for marketing and branding used to be what? Television, radio. But now it has completely shifted to what? Google, Amazon. Now, these are the platforms where customer is engaging actually. So now the platform, because of technology, has become such where customer is coming to your platform and engaging and telling their behavior that this is what I am, 24/7. So if we connect all these dots, there is a complete shift which we are seeing, and which I said earlier, that now it's not going about in days to come that I have to explain feature to the customer. No, that era will be gone. Now, whether it's 2 years down the line or 3 years down the line, but yes, it's there. And it is going to be seen and felt by us. where customer will buy the product. Now, how fast we connect, and that is where what Mr. Shivashish also said, can I predict at what pace, kab hoga, at what time? But days are not far off when innovation, product basket, need of the customer fulfillment will happen on real-time basis because of the embedded technology, because of what we can see today, wearable devices getting connected on real-time basis. In few markets, it has already started happening. Look at India today. 33% is digital revenue. Digital economy is growing at 30%, which is even faster than developed countries. So this is how we see how this market, what you said in tier 3, tier 4, because of the higher literacy rate, because of cost of adopting technology at rock bottom prices, mobile phones, smartphones acting like a supercomputer in the pocket of the customer, we see explosion ahead, and that is where the market lies. And that is how India's GI penetration and, density is bound to increase.
So Ravi, coming to you on the same topic, when you look at retail health and you look at the new millennials or the Gen Z, when you talk about, how do you see that these things are changing? How the customer expectation landscapes are changing? Is it becoming shorter now, the expectation change? Or how do you see it? And how do you think that the insurers are responding towards it?
Sure, great question. To respond, I'll kind of tie back what Vidya was just saying and what Alok said right at the beginning. So if we look at some of the younger people, of course, there's an invincibility complex. But one thing that COVID has done is it has made people more aware that you can be young and still get quite sick and need access to really good quality care. So we are kind of seeing that. We recently launched a new product, and the product is towards the higher end of the market in terms of sum assureds. And we were wondering whether older people will buy a higher sum assured versus versus younger people. And as it turns out, what we are now seeing is that the younger people are buying far higher sum assureds than they have ever bought by factors of 50% plus. And so we can certainly see that movement happening. But at the same time, I think that as an industry, all the things that Vidya said are true, and they all should happen. But if I go back to what can stop it from happening, I think it goes back to the thing that Alok said about trust. And there is still some level of mistrust, distrust that people have, including people of the younger generation, with insurance companies. They're not exactly confident that the insurance industry understands their needs, that they will fulfill their needs, and they will actually be there to serve them when they need. And I think as an industry, the industry pays a lot of claims, 30,000 crores of COVID claims, as I said at the introduction. The industry pays claims. I think we just need to go out there and one is do more to earn people's trust and show them we deserve their trust. That's one part. But the other part also is that we need to think about propositions. So far, if I think about health, the propositions that have been made are largely for a certain group of people. 35 plus in relatively good health, maybe 40 plus in relatively good health, largely in metro and tier 1. But there is a significant need for to cover other people who don't fall in this bucket, who can be on this side of the bucket or on the other side of the bucket, both in terms of age as well as health. And all of them need protection. They need access to the best care. And I think the more such needs that the industry caters to by coming up with the right propositions, backing it up with service, communicating the fact that that we can be trusted, and doing it all digitally so that the experience is the experience that people expect from an Amazon or Uber or Zomato, Swiggy, whatever. All those things need to happen for us to be able to really capture the opportunity that Vidya laid out.
No, thank you, Ravi. I think this expectation change along with the service propositions that we are talking about I think this will make the insurers more sensitive towards the customers. And when the customers realize that the sensitivity on the other side of the insurance companies are higher or matches with them, most probably that will be a win-win situation. So shifting to a different topic, Alok, when we look at this entire topic of digitalization, we saw what is actually happened to the COVID period. The regulator also came up with a number of new products or changed processes. So in this backdrop of increased digitalization, digital adoption, on the other side, the pandemic, do you think that the new products are also emerging in the general insurance space?
The new products are emerging. There is no doubt about that. As Ravi said, that we need to look at products for younger generation, etc. There are 2 or 3 things I would like to mention. One is that we are not looking at the customer of all ages and of all types of prosperity. So, for example, somebody who is a, say, millennial or a Generation Z, as we call, we did one survey and we tried to find out what is the kind of protection or what is the kind of insurance they would like to take. You would be surprised to know that they were asking things like, can I get protection against hacking of digital identity? So we are talking about cyber security. We are talking about health insurance. They are bothered about their digital identity, that if somebody hacks their digital identity and sort of miscommunicates with that identity. Those kind of things are bothering the millennial people. So there are many things that people have not thought about. Today what happens that normally before the age of 35, a normal young person doesn't think of health insurance. He would rather buy a mobile phone than buy health insurance. There are very few people who are like in health insurance business or their parents are very aware and they force them to take it. But if they're from their own pocket, very few people will buy and go and buy their health insurance. So it is when they get their first shock of some kind of hospitalization or something to their very near and dear ones, that is when they first think about health insurance. But there are many other needs which they are bothered about, and which we as an industry we have not yet thought about. Now cyber insurance is becoming important. Cyber insurance on retail side, cyber insurance, whatever is now sold is on the wholesale side. On the retail side, cyber insurance is coming out as a product. The other thing is that the people don't they want everything to be done digitally. If a 20 to 35-year-old, you go and ask him, how do you want to settle a claim? He said, everything I want to do on my mobile or computer. I can give you an example of a company, US company, which I studied. I'm sure you would have heard of it. It's a very famous company called Lemonade. This Lemonade basically is into home insurance. And they settle home insurance claims in a matter of seconds or maybe a minute maximum. And everything is done digitally. Today, most of the information that is required is actually available in some form or the other with us. So if we are able to win trust or actually to sell the product, we should be able to identify the need or at least understand what they are thinking about. So Amazon is talking about giving the product same day. We are saying that he is giving a physical product. We are giving a digital product. Anyway, we are giving an email to them that this is your policy, which we still say that it will come after 5 or 6 years. Of course, there are some stakeholders whose things we have to manage. But you think of a physical product coming the same day, and we are saying that email will come after 5 or 6 days. The expectations that we are trying to set is completely different. We are in a different world whatsoever. So, basically, in a small policy like a personal accident, we ask for a succession certificate. There are many companies who ask for, but there cannot be a more draconian document than a succession certificate. Because succession certificate, if anybody has lost his parent, he can find out that if you go and ask the authorities for succession certificate, it is a nightmare to get it. And still we insist, substandard ho jayega, nahi ye ho jayega, wo ho jayega. Those kind of things are there. So we have to move out of that mindset that if we don't trust the individual, they will not trust us. And to catch hold of the fraudsters, we have to have a very strong fraud control mechanism, so that because there are some fraudsters in the system, everybody is a thief till proven otherwise. that kind of attitude will not work. So although we have moved a lot as far as the digital economy is concerned and digital insurance is concerned, insurtech is concerned, there is a lot more to be done to actually explore this market. Why is it that even developing countries have a more penetration in insurance than us? And we have to ultimately look forward to government to come out with Ayushman Bharat type of schemes to increase the insurance penetration. Today, even after insurance penetration is perhaps more in the poor people because of these Ayushman Bharat kind of schemes than in the I would say the missing middle. The middle income people, they don't have insurance. It is the rich who have the insurance. It is the poor who have the insurance. It is the middle class who doesn't have insurance. The missing middle, those who are in the business class, those who are not in a corporate world, they are the people who don't have insurance at all, especially health insurance. So there is a lot we have to do, and we have to use a lot of digital intelligence to design a product as well as service a product.
That's interesting. I think, Alok, one thing that you spoke of is the cyber insurance. Of course, with the huge digital adoption, this will be one product I think people will require, because the kind of financial losses people may see from various strata, and that doesn't depend only on the rich or the haves. The people absolutely below the poverty line, whoever using a mobile smartphone for transfer of even 100 rupees are susceptible to that. I think that is one good thing. Just to make a comment, you spoke about the lemonade, and when we look at the entire digital adoption, I'm reminded some 3-4 months back, Lemonade said that their motor insurance is being settled through AI. And there is a huge uproar because people said, how can you settle and reject my claim? How can a machine reject my claim? I have paid you as a human your premium. How can a machine reject the claim? I think this is also very, very important today. At the time of digitalization, I think the insurers have to also keep in mind the human angle and the empathy, the touch, that humanization of digitalization, if that is a word that we can use, also needs to be done. So coming to Subhashish, to you, how you see the life insurance industry products are changing, or any new products, any new areas that you are thinking of?
Yes. So what has happened is that now we have realized, realization was always there, but possibly we need to have greater living benefits, which life insurance companies did not have that much. I mean, living benefit was really annuity payment and all that. It was more of an investment product, not really the insurance part of it. So definitely living benefits will start playing a much larger role than it has happened today, because even people who are surviving and coming out of COVID, their health is impaired. People are falling sick again and again, and all those things are happening. So that is one thing that life insurance will do. The second thing is that what else can life insurance do? Should we look at paying a part of annuity, use it to put the aged parents in an old age home? There are so many things that all of us are thinking that, of course, if you look at regulatory change, but the thinking first has to start. What the regulator will do, we have to also, talk to the regulator that this is happening abroad. So possibly ideas from there. See, as you rightly said, Pathunil, just as digitization has shrunk the time frame for change, even the thinking now has shrunk. What would think it is going on, let it happen 1, 2, 3, 4 years later. Now I think people are rushing to put together everything that is possibly give a totally holistic situation to what the person will want. Particularly this current generation is kind of caught between the situation when you look after your parents and your children are going away. So you are neither in an old age home, neither are you completely left your children go away. So you are kind of middle. So how do you fill this missing gap, as it were, in this generation, which has these 2-3 liabilities simultaneously to take care of? Do you have a product that lies it? Can insurance be there? Insurance as service also exists, which is life insurance. And with the money, I give you services that otherwise you would have used the money for. Can you depend upon a life insurance company for that? Can I put you up in old age home and pay your annuity along with that and take care of few other things? Or if an event-based something happens, I will take care because children are abroad. For an amount of money which is there along in the policy. To that extent, the policy amount pays off. Those are the things that life insurance companies are looking at and will increasingly be looking at. to give a holistic thing. Because ultimately, one thing is that for the life insurance company, normally we would have a person for a much longer period of time. Unlike health, and with that company, with that relationship with that person themselves, health, you can change. General insurance also, you can change your company as the products came on. This life insurance is one of the products will be there with you for a long period of time. So let's do something about it then.
I think very, very interesting, Shivashish. I think with a changing lifestyle, changing environment, the insurance companies, if they bring new propositions, that is the way we'll be able to increase the penetration as well. The requirement, the actual requirement, rather than to say that I have this product and please buy it, rather than to say that what you want and these are the benefits, these are the things we are in building.
Yes. Yes.
So after this, I think one of the points that we were seeing in the last few months, the entire valuation in this industry, largely we have seen, Shivashish, unfortunately, we have seen in the general insurance industry, in the health insurance, also the aggregators, the so-called web aggregators, the kind of valuation, the kind of multiples that we are looking at, it's something which no one could predict 2 years back. Coupled with that, a 74% foreign investments in insurance sector. So I will first ask Alok this, that how do you see the insurance industry changing with this? Are you going to expect more capital, more M&A? Because I was also reading globally, M&A is a very, very big topic, certainly in the insurance industry. So in India, on one side, capital, secondly, multiples, so many companies with various kinds of market share. How do you see that in the next 2 years, how it is going to happen?
Look, this money chasing a few companies is not only happening in insurance, it is generally happening in the overall stock market. So it is all a matter of demand and supply. Today, because of scarcity of supply of relatively stable financial stocks, if you classify insurance as a BFSI industry, we are relatively stable because we have a large investment pool. We also do insurance. And so that investment pool is what they are looking at. And since this investment pool is generally invested in a highly rated paper and some bit of equity, so this is an attractive proposition. And you say we are under-penetrated market, health insurance is going fast, and this story has been sold. And coupled with it, at least in general insurance, there is only one private sector company which is listed, and in life insurance there are three companies which are listed: SBI, ICICI, and HDFC. So basically, the supply is limited and the demand is good. But ultimately, what happens in the long run is that you have to perform. You might get a good valuation to begin with when the wave is at its crest, and once the issue happens, the money is raised. People who are old enough as I am would remember the Harshad Mehta days, and when everything and anything was lapped up, and there are many companies which have gone into LCLT and closed down. And I remember I had invested in SR Steel at one point of time in 1992. So I still have those shares because it is now converted into an unlisted stock. Basically, ultimately, the sanity prevails when after 2 or 3 years, if whatever is promised is not delivered. So in the short run, people are giving the valuations based on an expectation, based on the expectation of industry, based on the expectation of the individual company, based on the sector. But ultimately, it is money has to give returns. If you don't give returns, even the best of companies have lost flavor. And you can see that Fortune 500 companies that were there 50 years back, if you look at today, there's hardly 1 or 2 companies which are still existing in that Fortune 500. All of them have disappeared, and either disappeared or come out of Fortune 500. So there is nothing sacrosanct about it. That today, if you get a huge valuation, you will remain at that huge valuation forever. So you have to deliver to remain at that kind of valuation.
No, that's quite interesting. What you are saying, okay, fine. There is a shortage of supply. And so for good financial stocks in the insurance sector, this is a growing sector, so money is chasing it. But on that backdrop, I will come to Ravi. Ravi, you have seen it all, and today when we are looking at the valuation of the distributors, the digital distributor, It is more than some of the manufacturers of insurance, or when you look at the health insurance sector. So there is a company which was invested at a particular X value 3 years back, and the one that we read in the newspaper, they are talking about something between 3x to 4x within 3 years. So on this backdrop and the so many fragmented market share of the industry, how do you look the industry 3 years from down the line?
Well, I mean, it's my personal view. My personal view is that if we're talking the example that you shared in terms of standalone health insurance companies, I think standalone health insurance companies, by the nature of the business model, by the nature of the market and the potential in the market, I think for some time are going to be perpetually in some kind of fundraising. In the last 2 years, if you look at all the standalone health insurance companies, with the exception of one, all of them had some kind of shareholder action. Either they had new shareholders come in and so on, or they had changed hands, they got sold, because they're always going to be in need of capital, given the nature of the business model. So I don't think that is going to change. That will continue, but I think valuations ultimately are they look at all the factors that Alok was talking about, plus the potential for growth. And I do believe that in the long run, company quality will win, and companies that are able to manage their P&L well, that are able to actually deliver a profit, will end up having better value and delivering better value to their shareholders. So distributors are also growing, and distributors are getting huge valuations. It is a revenue dependent model, right? But the hypothesis is that the rate of growth of revenue is going to be so high that what appears to be very expensive today will not be seen as expensive tomorrow. And the example that you quoted of one of the standalone health insurance companies is kind of proof of that, because the growth trajectory, the value of growth in that valuation is so high that what seems expensive today may not be expensive tomorrow. But then, of course, the people have to deliver that growth. And if that growth doesn't come through for whatever reason, external reasons, internal reasons, it's going to be quite painful for some of those companies. So I think it's a number of things, but in the end, quality will win. And that's why I think everybody should be focusing on that, on having a healthy balance sheet, healthy cash flows are as important, if not more important, than top line.
So what Ravi and Alok are saying, that please focus to the basics. If the basics are right, you are going to do absolutely fine. So that is there. Whatever the valuation, do your work, do your basics right, and it will be fine. So coming to the last section, and before we close, so I'll come to you, Vidya. That today, what we see that in the last 2 years, the global growth in insurance is coming back. So they are projecting that in non-life, the global growth will be at 3%. It was flat last year. Life insurance will also be at 3%, and actually it was minus 6% last year in this calendar year. In India, we are looking at the infection rate stabilizing. Most probably the hospitalization rate, or at least the requirement of ICU and the oxygenated beds, are reducing. So with this backdrop, it's a very, very optimistic backdrop in that sense, because when we started this journey 18 months back, or even 7-8 months back, when the second wave hit us, on that backdrop, I think all the organization and whatever we discussed today, you all have prepared for the future. So you know something about the future. Subhashish spoke about building blocks. You spoke about how the higher literate people in that tier 2, 3, 4 towns are having a changing expectation, and how they are going to propel the growth. So on this backdrop, what is your organization's top 3 priorities for the future? For the insurance?
So coming from our organizational perspective, the top 3 priorities, which is very clear, and that we have also shown during pandemic times, as I said, that what has helped us scale through was the pace at which we were creating distribution. We took it as an opportunity, and that continues to be so. So that is one. Second is product. Again, as I said, customer is changing. Now, today, what is the expectation right now? Tomorrow it's changing. Customer is no more comparing us with one insurance company to another insurance company. Customer is with me, in fact, also with Amazon, Google, and Lemonade. That is how customer behavior is changing. So product becomes very important, what I do. And technology at the top of it. The way we are going to leverage the data, the way we are going to, customize the need of the customer, the way we are going to service the customer at the doorstep. So these three for us are the critical driver: the distribution, the product, and the technology. And also, when I have to talk about the technology platform, today, if you look at just taking a cue from what Ravi said or what Alok sir said, just touching a point from valuation, merger, acquisition. So I'm correlating to some extent in that pointer. So merger and acquisition will happen. This is an industry where profit has a long gestation period. So companies with deep pockets will vie for that. But does it stop, small suppliers entering into the market? Answer is no. And that is where we are seeing, because of the opportunity what India as a country has got, because of the entire evolving ecosystem, InsurTech, FinTech firms entering. And they are tying up with the manufacturer. What does this lead to? Because this will correlate also to my point of distribution, product, and technology. What does this lead to at the end of the day? InsurTech and FinTech firms are having the data hegemony. They have the data. They know the customer. They know their behavior. We as manufacturer know the product, know the life cycle of the product.
No, so Vidya, I'm just stopping you because of the paucity of time. And I take your cue on distribution, product, and technology as the three priorities for your organization. Subhashish, coming to you for the life insurance point of view, or your organization, Kotak Life, what are the three priorities for the future after these two waves, and hopefully there will be no third wave?
Very clearly, digitalization. On that, there is no escape. Second is products that are more responsive to the customer and possibly trying to be far more innovative than what it is. If the regulation doesn't allow, engage with the regulator and see from the industry as well. This is what the new regulation, new requirements are there. And finally, very importantly, skilling and reskilling all our employees, colleagues, and all our partners. It's a reset, a very new reset. Do we require office? Do we not require office? Can you sell insurance through Zoom? Can you not sell insurance through Zoom? How do I digital visiting card instead of personal visiting card? How the advisor uses social media to make his or her presence? The entire package around it. So the three things I would say: digitalization is on its own, innovation in terms of products and processes, and reskilling of all our people.
I take your point, Subhashish. The reskilling part is so important with the changing times. We have to change ourselves. Coming Ravi to you, what are the three priorities? What are your three priorities?
I think, as with everybody else, digitization is first. But to that, I would add two things. I would add agility. Agility in terms of being responsive to market needs, being kind of closer to customers and changing as required. And the third thing I would add is empathy. Empathy to the customer, to make sure that we're in the business of paying claims, as I think Alok said earlier. So to make sure that is done empathetically, and also to be empathetic to employees. To pick up what Subhashish was saying, because employees are also going through a change. distributors are going through a change in how to work. So to be empathetic to that, I think is important, and supporting them through that journey. So digitization, agility, and empathy would be the top three.
Thank you, Ravi and Alok. Three priorities, and as we close.
So I would not like to repeat what Vidya and Ravi have said. They are all our priority elements. Only thing that I would like to add is that we would add customer centricity to everything that we do, and therefore claims is our core product, and therefore claims becomes the most important factor, and everything that can make it smoother will be our priority.
So thank you, gentlemen, very much for an exciting discussion. Very, very good discussion, because one thing is that we have gone through a crisis. We are coming out of the crisis. The demand is back. Suddenly insurance is becoming a pull product. But what is very, very pleasant to note, what is very, very satisfying to note, that the insurers are, during this demand times where people are asking for insurance, we are looking at how to make the customer journey smoother, how we are becoming more customer centric. And some of the words that I've heard, reskilling from Subhashish, or from Ravi, empathy, and from Alok, from you, customer centricity, and Vidya, you mentioned about technology. So all these things also shows how the Indian insurers are becoming more mature, coming out through these two waves. I wish you all the best, and I think that we don't see any further wave, Arnab, and we do not have to go through any waves on next year when we meet. We keep all the way at the back, and we will be on the road and driving through this. So so thank you very much, gentlemen. Thank you, the spectators, the audience, and thank you, Bengal Chambers of Commerce, for organizing this. Thank you very much.
Thank you all.
Thank you all.
Thank you all.
With this, we are ending the session on insurance industry. We'll be coming back in few minutes with our valedictory session with SBI Chairman. Please stay with us. Thank you once again.
रामू, 2 चाय दे यार।
अरे नहीं यार, एक चाय कॉफी।
इसको 30 डिग्रीज कर देते हैं।
अरे नहीं यार, 45 डिग्री सही है।
इस बार मनाली चलते हैं।
नहीं नहीं, गोवा।
सच है, we Indians disagree on everything, but we agree. SBI is the banker to every Indian.
अरे SBI कॉन्टेक्टलेस डेबिट कार्ड। सही भाई, आई एग्री।
SBI का वीडियो KYC सेविंग्स अकाउंट। सही है यार, फाइनली आई एग्री।
SBI से ट्रैक्टर लोन लिया, पाजी ये 100% सही किया।
SBI का होम लोन। जानू, दिस टाइम आई एग्री विद यू।
आप भी अग्री करेंगे। SBI is the banker to every Indian. बाकी बातों पर लगे रहो।
मुंबई मुंबई,
चेन्नई चेन्नई।
Good afternoon, everyone. Welcome back to the valedictory session on Indian financial market preparedness for the next normal economy. We have SBI Chairman Sri Dinesh Kumar Khara with us. I request Mr. Abraham Stefanos, President Designate, Bengal Chamber of Commerce and Industry and Managing Director of Tata Steel Downstream Products Limited to kindly deliver the welcome address, sir.
Good afternoon, ladies and gentlemen. It is my pleasure to extend a very warm welcome to all of you today at the valedictory session of Financial Markets E-Conclave 2021, as we are all waiting for one of the most interesting sessions today from the chairman of the largest PSU bank in India. At the outset, I must thank Sri Dinesh Khara, Chairman, State Bank of India, kindly joining as the guest of honor at this valedictory session despite his extremely busy schedule. I also extend my heartfelt gratitude to Mr. Tamal Bandyopadhyay, author and columnist, and our mentor of the Banking and Finance Committee for making this possible. The banking industry is being hit hard by strong headwinds, the power of the market and the power of technology. While greater disintermediation is eroding banks' advantage as deposit mobilizers, technology is throwing up new challenges, and I must say new opportunities too. The use of technology is no longer confined to the payment space and loans. It has spilled over to the liability turf. One can book fixed deposits on the platform of Google Pay and Amazon Pay. Most banks have been able to absorb the shock of the first wave of the COVID pandemic with relative ease because of their balance sheet strength post AQR. But a different kind of mispricing of risks is seen today, which could land them in trouble. Banks are lending short-term at 4 to 5%, discounting bills and other ways unheard of till now. Higher inflation and its impact on the economy is one side of the story. How have banks been dealing with excess money? Is it a liquidity trap for the economy or a liquidity drag for banks? Both the body and soul of the industry has changed. The seller's market of the 1990s has become the buyer's market of today. From addressing the cycle of life, the lifestyle of the customers is on the bank's radar now. It will be interesting to understand the dynamics of the Indian banking sector after 3 decades of liberalization. I will not take any more of your time. We have with us one of the most eminent speakers in the banking industry on this subject, and I am as eager as all of you to hear his views. I will request our Mr. Tamal Bandyopadhyay to take the session forward. Thank you. You are muted, Mr. Bandyopadhyay.
Good evening and a very warm welcome to the last valedictory session of Bengal Chamber of Commerce, and we have with us Mr. Dinesh Khara, Chairman, State Bank of India, proxy for Indian economy. So, and this is a fitting finale of the day-long event because it started with the former Reserve Bank of India Deputy Governor Mr. Gandhi. We spoke about macro issues, economy, normalization by Reserve Bank of India as and when that can happen, technology, market disintegration, etc., etc. And now we have none other than Mr. Khara. 1 out of 3 Indians is SBI's customer, if I'm not mistaken. So 46, 47 crore customers State Bank of India has, and it's a proxy for Indian economy. It's about more than 1/5 of Indian banking segment. So let's cutting the fab and let's start getting into the real discussion. Khara sir, the subject is Indian financial markets preparedness for the next normal economy. Thankfully, the worst is behind us as far as COVID pandemic is concerned. We are tackling the second wave. Hopefully, it's receding the impact of second wave, and probably we are well prepared for if at all that happens, the third wave. So tell us, sir. Let's give your preliminary remarks. How well prepared are the Indian banks? Because we are talking about you are representing the entire banking system, not State Bank of India alone. So what's your take on that? Let me hear you first, then we'll get into some nitty-gritty and micro questions.
So you have to unmute.
Khara sir, you have to unmute.
Yeah. Hope I'm audible.
Yes, sir.
Yeah. Thank you very much, Tamuda, and thanks a lot to Mr. Abraham for the opportunity which has been extended to me. Well, of course, when it comes to the Indian banking system, which is actually a proxy to the real economy, very important for us is how the real economy conducts itself. Having said that, banking is one such industry which is into the intermediation, and there cannot be a perfect situation ever. When the deposits are flowing, it may not be the right opportunity available for deploying those deposits. So that's why we always look for the alternate options, which happens to be investments. And also very often we invest them into the T-bill, G-Secs, SDLs, etc., if right opportunities are not available. But yes, of course, we have to be very mindful of the fact that the depth of this market is also very shallow. That being the situation, at times there is a temptation on the part of the lenders, on the part of the bankers, to really go down on the risk curve, and that is something which we have already started witnessing, and also mispricing the risk. So this is something which is which at times happens. But I think very important at this stage is to ensure that one, of course, the liquidity which is there in the system and which is also there with the customers. We as the responsible bankers have to ensure that we offer them the products and services which can be used for deploying the liquidity, and the customers should not get the temptation of investing their hard-earned savings into the products which can be risky in nature and which may not suit their risk appetite. So that is one of the very major responsibility which is there with the banking system. And now I would say it will get extended even to the financial system of the country also, because when it comes to the financial sector, it also involves the mutual fund, the life insurance, the pension fund. So all these kind of players also, they're also very, very responsible players when it comes to offering the product for the liability solutions for the customers. Second very important aspect is when the mispricing of risk starts happening. At times the entrepreneurs also tend to have a temptation of getting into the activities which are beyond their core competency. So I think this is something which all of us witnessed in the year 2008 and around. And that was a point of time when people got into the unrelated activities, and later on they actually burnt their fingers. Now in fact today, when it comes to the situation like today's, banking system has learned, though very hard way, in terms of providing for these loss assets. And now many of the banks have strengthened their underwriting standards. But yes, of course, mispricing of risk, I think, is still a reality in the system. And that is essentially when the credit deposit ratio comes below a certain number, it becomes an anxiety on the part of the lenders how to deal with their stakeholders, which are the shareholders, one of them. So I think this is what the real life situation is. One has to strike a balance. One has to see that how much of the asset growth one can undertake, but one should not take away the eyes from the risk inherent in the asset which is being underwritten. So I think very important is sharper eye on the risk and also ensuring that we continue to create value for the investment and for the investors, particularly those who are trying to invest into economic activities. That is perhaps one of the reasons why the soft economic policy, soft liquidity policy has been followed by central banks across the globe. And it is probably a felt need that unless and until growth kicks in, there could be a challenge for the real economy to really meet up to the expectations of the customers, also shore up the demand, and also move towards the prosperity. So I think these are the compulsions in which the banking sector and the financial sector will have to operate.
Thank you, Mr. Kara. So I must say that you are very candid. The biggest challenge for the banking industry at this point of time is mispricing of risks, which they did last decade, and then they had to pay the price for huge NPLs. There's a push for credit by different quarters, including the government in different sectors like infrastructure, etc., and the bank paid plans for it. Now, tell us how long you think that credit will remain elusive for the banking system. You spoke about credit deposit ratio. It dipped to 69. Okay, for every 100 rupee of deposit, 69 was going to credit, which is pretty low in August. Now it is, I think, latest one about around 70 and all. Again, it's very low. Historically, it's pretty low on the lower side. So tell me, when do you see the credit actually picking up? And what are the segments? Are you seeing any kind of green shoots? Because normally we are talking about that consumer demand is coming back, economy is coming back on the rail, so on and so forth. On the fiscal front, there are a lot of good stories. So the government fisc is not that constrained as we had thought 3 months back. So things are looking up. Tell me, when do we see credit pick up? And have you already started seeing at least some green shoots in certain quarters?
So I think first and foremost, let me explain what you said about the demand from the government for the credit push. I think more than that, it is the temptation on the part of banks to really ensure that the balance should look good, which is really which is one of the reasons for people to get into the temptation of underwriting risk at a pricing which may not be right. So it is actually the pricing issue, mispricing. It is not the wrong underwriting. That is one thing which I would like to clarify. Your second question, which is essentially relating to which are the sectors where we are seeing some kind of a green shoots, etc. I would say that the growth in the industrial sector has not been universal across, but yes, nevertheless, there are certain sectors where we have seen a significant growth and the much better capacity utilization. That is essentially coming from the commodity sector. It's into iron and steel, it is into aluminium. So those are the kind of sectors where we have seen that people have already hit the roof by having almost 100% capacity utilization. And also these are the sectors where a lot of growth, a lot of export opportunities are also seen, and people are really encashing those export opportunities. So these are the sectors where we have started seeing some kind of early signs of the fresh investments coming in. I think these are the core sectors, and once the investment will flow into these sectors with the greenfield projects or the brownfield projects, I'm sure it will have an impact universally in the economy, and it will eventually lead to the firing of the growth engine. So that's what my take is, and we have already started seeing some such proposals coming in. The other important aspect which I must touch upon is the very pragmatic PLI policies, PLI policy which has been introduced by the Government of India, which is eventually going to give a kickstart to the SME sector in a very big way. These incentives will prove to be of significant use, and I'm sure it will lead to the growth in the SME demand also. And when it comes to whether we have started seeing some traction, yes, we have already started seeing some traction. One, of course, earlier we were seeing traction, which was essentially coming from the public sector entities in terms of the fresh investment spent. But apart from that, now it has some of the private sector entities have also started exploring and also approaching us for new additions, or alternatively looking for the brownfield capacity which is available in the debt resolution system. So that's the kind of a thing which we are observing. Apart from that, the road sector has always been promising ever since, even before the COVID had hit. So during the COVID period also, it never slowed down. So that's a very major positive, and it will. I'm quite confident that the kind of allocation which is there for the road sector, it will remain the growth engine for the economy for the foreseeable future.
Thank you, Mr. Khara. I think it will be music. It is music for those for the ears of those who track Indian economy. But tell us, do you see there is certain apprehensions in certain quarters that in our anxiousness to push growth, we may end up seeing or creating a situation, the irrational exuberance when it comes to bank credit in certain segment like green energy and all. There are projects, and there is like banks are not exactly flooded, but there are many projects coming up, and you are like with a very positive approach, you are planning to give money, etc. And we may end up getting into a mess. Is that the correct assessment, or you think no, I'm exaggerating?
No, my sense is that past the last experience which the bankers had, practically all the banks have strengthened their underwriting practices. So, and having strengthened the underwriting practices, I think the underwriting standards should not be the cause of any such exuberance. The only thing which I apprehend is that pricing may be something which could be a concern, because when it comes to when there's so much of liquidity in the system, perhaps it forces the lenders to revisit their pricing. But as far as underwriting standards are concerned, I don't think people are likely to compromise on those underwriting standards.
Okay, good to hear that, Mr. Khara. We can't have a discussion with the country's leading bank boss without spending a few minutes on the bad bank. Everybody talks about the bad bank. Now, how good is the bad bank, or how bad is it? Some people say it's too late, it should have been done earlier. There are also people who say that there's a moral issue involved. Is essentially, you people meaning primarily the private public sector bankers, you are just shifting your from assets from loan to investment. Same thing come in the form of SRs, and we will not be able to do much about it, even though we have great examples in front of us, what Malaysia did, just to give one example with that bank. So what's your take? How is it going to help Indian banking system and Indian economy? Quickly, if you can say.
Yeah, sure. I think this is something which is on the top of mind of many. When it comes to bad bank, the contours of the bad bank, which has been envisaged, are a little different from what used to be the ARCs in the past. So, and also the timing perhaps is the correct time when this has been envisaged. The reason why is that today is a situation where bad bank is not merely the aggregator of the assets. Also, it also ensures that aggregation of all such assets with the banking system should happen. So, which means that there are no loose ends left out when an asset gets transferred to the ARC or the aggregator, which is an ARC in this particular case. The second very important component in the bad bank is the debt resolution company, because it is not merely the aggregation, but it is also the resolution which is going to be value accretive. And for really achieving that, your question whether it's the right time or a wrong time, I would say that, it was post NCLT when we started seeing the ecosystem getting developed in the country for the resolution of the stress assets or the brownfield capacity. I think this is a step in a direction where the kind of ecosystem which has got created will be put to the further meaningful use. What really it helps in, and one, as I mentioned, in aggregating the assets from the banking system. So which means that time which used to get lost in aggregating the assets, it will be minimized to a greater extent. And secondly, the inter-lender litigations can be avoided. Thirdly, very important is in case of NCLT, it is not possible to sell the asset to the potential investor. But in case of bad bank, that possibility exists. And fourth, of course, the assets are going to be guaranteed by Government of India, which actually will lend a lot of credibility to these assets, and perhaps it will lead to the development of the secondary market for the assets also. So I think all said and done, to my mind, this is one of a good tool. I would not say that it will substitute NCLT, but yes, of course, like the way the bankers explore various options, including compromises, etc. This will be also one of the options which will be available to the bankers, whether they would like to transfer to the NARCA and also have the resolution done through this route or through NCLT. So perhaps time taken for resolution will be the determining factor while deciding either to go to NCLT or to go to NARCL or to go for the compromise route. So that's how I look at how the situations will emerge going forward in this particular space.
One more burning topic at this point of time in Indian banking system, Karasab, is what's happening in the mortgage market. Every day, every bank comes up and spices up the offer. You call it festive offer, you call it whatever you may, but yeah, 6.7, 6.6, 6.65, etc., etc. And no processing fees to waived, etc. So can you tell us, Mr. Khara, what's happening in the mortgage market? If you a decade back or more than a decade back, post Lehman, State Bank of India, if I remember correctly, that at that point of time started the teaser loan. Like for a brief period, the borrowers could take the mortgage loan at a very low rate, and the rates will go up later. RBI had to intervene, and then it was dropped. Mr. O.P. Bhatt was the chairman of State Bank of India at that point of time. Now it's not a treasury loan, but there's a very limited time loan for 2 months, 3 months. All the banks have to, and India's largest mortgage lender, not in the banking space, outside the banking, I think largest is State Bank of India if I look at the entire mortgage market. But HDFC also has joined the race, and you name it, Kotak, HSBC among the foreign banks. So tell us, where do we see this? Is it will actually create the demand, and this way of creating the demand, now later, as and when the rates go up, because the floating rate, it's all floating rate, then will you see any problem for the customers?
See, when it comes to when it comes to the mortgage market, again, very important is the underwriting criteria, which in our case is EMI NMI ratios and also the credit scores. What is being attempted here is because what you mentioned, that whether it will lead to the growth in the market, perhaps the market has already started showing signs of growth in this particular market. And it's an attempt on the part of the banking system to capture the opportunity which is available. So competition on the price point can go only up to a certain extent. Beyond that, it is going to be the delivery on the ground, which will matter. And also the reach, which will be very significant then for anybody to take a decision. So I think as I read the situation, perhaps there's ample scope for the system to grow. And more so when it comes to the mortgage market, there are, with the advent of nucleus family in the society, there's enough demand which exists for the first time home buyers as well. So I think as I read the situation, perhaps it is not. It's not a situation where the price war will perhaps continue indefinitely. Price war is just to entice the customer. And your other question, whether with increasing interest rates, will there be a challenge in terms of the customer's ability to honor their commitment? Normally, as I mentioned, that the EMI-NMI ratio, which is very important for us when we take a decision apart from the credit score of the borrower, because credit score actually captures the history over a period of time. So it is the abnormality which is seen today can be an aberration, but if at all we will have the benefit of the history, we can have a better assessment in terms of the credit risk. So to that extent, I don't envisage that it is likely to create problem for the bankers in terms of the recoverability of such.
Okay. Gaurav sir, just one supplementary question on this. I'm sure many of the people who are in the audience, they would be home buyers or they're planning to take fresh loans, etc. So the new offer which the banks and NBFCs, mortgage companies are offering, they're the floating rate loans, but they are only applicable to the new borrowers, right? If I am an existing borrower, I'll not be able to get that benefit, right? Am I correct in assessing this?
Yeah, you are very right, because these are the contracted loans, and at a point of time, whatever is the contracted rate, that will be applicable. But whenever the readjustment happen, that's a point of time, because these are linked to MCLRs.
Okay. And sir, again, talking about mortgage and other loans, like the COVID impact, what we saw is people losing jobs, people also seeing salary cuts. They are being gradually restored as we recover from the impact. Has it dented the these retail portfolios? Again, I'm not talking about State Bank of India. I'm talking about general banking industry. Is there any impact of COVID on the retail balance sheet?
I would say that because in the first, in the second wave, when we had a challenge in terms of mobility, there were various containment zones which were created across the country. And because of absence of mobility for a greater part of the first quarter, there were certainly challenges as on 30th June. But with the mobility having got restored, our ability, the system's ability to reach out to the customers has improved significantly, and that is something which is showing up in the collection behavior of the system also. So I would say that yes, as at the end of the first quarter, there were certainly some challenges, but because of the people's ability to go back to the customers and also the cash flows having got restored for large number of customers, this is essentially the necessity. Home loans are the necessity for many. Many are the first time home buyers. So naturally, this becomes a priority for them to honor their commitment. So I think to that extent, it has the portfolio has whatever stress it had seen at the end of first quarter, that has been addressed to a greater extent over a period of time in the second quarter.
Okay, I promise that we have 30 minutes, not more than that. We'll stick to that. So you have just 7 minutes left. I have quick 3 questions to you. So 2 minutes each, and that's how it will happen. So tell me about, Mr. Abraham spoke about technology. State Bank of India, you have the which is sort of, it's very, very interesting and very, very useful. I mean, you actually made the elephant dance. So tell me on the technology front, have you done enough, or you think that, I'm not talking about on behalf of the banking system, because there are many laggards and there are quite a few who have done also a wonderful job. But since you are the biggest lender in India, have you done enough on the technology front to compete with the fintechs or whatever it is, cohabit with them? Or you think no, more needs to be done in the current scenario?
I would say that technology investment is an investment in a channel, and it's not a destination, it's a journey. And I think we will have to keep on upgrading, and that will eventually entail continue to invest into the technology and be relevant for the time and the age.
Now, in terms of products, etc., can you give us a sense? Like if I'm a bank customer, be a borrower or a depositor? What are the things we can expect or is being offered now, which is for me, it's a convenient for me, which was not there yesterday?
Yeah. No, well, in fact, during the period of COVID, I think it is something which I would like to put it on record. The PAPL, which is pre-approved personal loans, which we actually figured out with the help of analytics, all those who can be offered these loans. We had underwritten about 15,000 crore in the last 3 quarters of the previous financial year, which is 2021. And during the current financial year, we have already underwritten about 9,000 crore worth of loan till now. So that is something which has been made available, which is end to end. Similarly, when it comes to our COVID coverage, that also we offered through e-channel. We have started offering gold loans with the help of e-channel, which actually carries out the process to a greater extent, but for the only one formality of going to the branch and handing over the gold ornament. Similarly, we are processing even the home loans with the help of this and when it comes to agri, we have got a agri wherein we are reviewing the agricultural loan, which are KCC loan, with the help of so it is actually helping us in multiple ways. One, of course, the customer convenience, which is the topmost in mind, and second, of course, when it comes to reaching out to the customer, we know whom to reach and how to convert the business. So cost of acquisition of the new business has come down. And third, of course, when it comes to operational efficiency, even that also it is offering. So we are constantly on the constantly on the job to explore newer ways, newer products, and newer channels to offer the services and product, so that we can have the customer's mindset and mindshare.
Yeah, thank you. The COVID coverage is the health loan, right?
Yes.
That's all. Yeah, I understand that it has become pretty popular and you have disbursed too many loans on that. Tell us on the macro, this is my last but one question is this. At the macro scenario, everybody is talking about so much of liquidity in the system. You don't have too many avenues, so you're just putting money, 8 trillion rupees every day at 3.35 at the Reserve Bank of India reverse repo window. And of course, you can get 3.43 or something at the variable reverse repo auction and all. So that's what is happening. It's too much of liquidity sugar is crossing the system and all. So tell me, as a banker, do you think is the time for the Indian Central Bank to do something about it? Because the latest credit policy or the MPC meeting in October 1st week, we are about 10 days, 12 days away from that. So is the banking community expecting sort of any hint from Reserve Bank of India, any change in stance or the beginning of normalization, which FOMC meeting early this week hinted at, which central bank, like as we speak, Central Bank of Pakistan, of course, it's not relevant for us, hike the rate, Norway hike the rate, and quite a few in the past 2 months have been hiking the rates. And the language of both Bank of England and Federal Reserve has changed. And of course, Federal Reserve has clearly said that things will start happening sooner than what we had anticipated. So what's the India scenario how do you look at it?
Yeah, as far as when it comes to deciding the rate by the central bank, apart from the liquidity and its impact, which is in terms of the inflation, which is actually it shows up in terms of inflation. The other very important factor, which is always kept in mind by the central bank, as we have read from in past couple of months and the quarters, is that the growth. I think growth is only showing, only green shoots are seen when it comes to the real economic growth. So I think perhaps the rate may not really go up, but commentary could talk about inflation. But to my mind, inflation is essentially on account of the supply chain disruption. And once the supply chain disruption gets addressed, perhaps inflation may not really raise its head as much as it was seen at the time of the last policy season. So I think if at all inflation gets addressed by the supply chain readjustments, perhaps will have elbow room for keeping the rates at the current level and wait for the growth to come back in full force. And perhaps that will be a point of time when central bank might think of recalibrating the interest rates. But as of now, to my mind, it looks like that the interest rate should remain as it is. The commentary will be watchful. What will be the commentary?
Thank you, Mr. Kar. So you don't expect any action as such in October. My last question, sir. Tell us just a minute to end it. What are the key lessons learned from this COVID pandemic, and how strategically your approach to business in this new normal scenario? How has it changed, or how will it change?
Actually, COVID brought a reality to the door that digital has moved at a very fast pace. So the need for augmenting the capacity in digital has gone up significantly, and which we are doing also. And the other aspect is that when we used to look at the DRP, we never visualize the situation that there can be a situation where the humans may not also be there. So we have started looking at the DRP options, how things will move in the absence of human, and that too from the remote location. So information security, cyber security has assumed much greater significance because the number of transactions have gone up significantly, which are done through digital. Need for the digital literacy has gone up significantly because many first-time users are now consuming digital as a transaction medium, and that is the way forward. And I think we have to adopt to these new realities, and which you have done it also, but we will continue our journey in this direction.
Thank you, Khara Sahab. I would not like to spend time in summarizing what you said. Everybody listened to you. So that's Mr. Dinesh Khara, the chairman of country's largest lender, State Bank of India. And that brings us to the end of this valedictory session. Over to you, Mr. Abraham and Honor. Thank you, sir. Thank you.
Thank you. Thank you very much.
Mr. Khara, for the very insightful talk. I think all our viewers would have enjoyed this session. It is hearing it from the horse's mouth, as the saying goes, and it's a fitting conclusion to this conclave. I will request Arnab Chakravarti to conclude the session for us.
Sir, it's a pleasure and honor to us, and we are overtly thankful to Mr. Khara. I know all of us know that you are tremendously busy, and we're really grateful to you that you have joined. And of course, our mentor, Mr. Bandyopadhyay, without you, this wouldn't have been possible. And with this, we would conclude. I think we have covered all the segments of the financial sector today. We look forward to meet all of you physically in Mumbai, and in a conclave where we look forward to do it physically, sir. That's all we wanted to say. Thank you, sir. Thank you.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.